pops up every time or if it was just that first time. But again, if you need, give it to permission to record, I do so. I appreciate. And like I said, these recordings are going into that YouTube channel. So the email I send you guys this evening will have this morning's class and this afternoon's class. And then as we finish, it'll continue to load. So we're looking at my cornucopia. Are we seeing, is that what we see right now? Yes. Okay. Okay. I don't know. Zoom's been weird lately. So if something doesn't look right on your guys' end, please say something. I'm not guaranteeing that I can fix it, but at least I know Zoom's being weird and I already know that. So, all right. So before break, we talked about loan estimates and closing disclosures. How many days after loan application do we have to send out the loan estimate, or does the lender send out the loan estimate? Yeah, 3. 3 is just a good number to remember when it comes to TRID days, you guys. I know there's numbers of days for this and that and everything else, but with TRID world, 3 is just a good day, a good number to remember. So the lender has to worry more about what defines the loan application. So for us, we're just kind of sticking to the big picture. And the big picture of the loan application is when the lender receives certain information about the people and certain information about the property. So now that we have the loan application, the lender has 3 days to send out the loan estimate. And again, the thing I really want you to see here, hey Kay, the thing I really want you to see here is that word estimate. Y'all, we just went under contract 3 days ago. We don't have final end all be all numbers yet, but the lender can provide this estimate to help the consumer better understand their bottom dollar. So you can see at the loan estimate, I have our borrower, the property with the sales price, and then we have the loan terms. This tells me it's a conventional 30-year, the rate's already been locked in, et cetera, et cetera. We scroll down a little bit. Here's your loan amount, interest rate. Here's your estimated principal and interest. Is there a prepayment penalty? Yes or no? Will there be a balloon payment at the end? Yes or no? So it's pretty clear for the consumer to look at kind of the big pictures of the loan. If they see on the loan estimate that there's a prepayment penalty, they may have questions. And this would be the opportunity for them to contact the lender if they want to know more about that. Does that make sense? That's why the lender's sending this. We're educating the consumer about their loan before they sign off on it, before they agree to this 30-year commitment. So when your buyer calls you and says, I don't want a prepayment penalty, then we need to encourage them to talk to their lender. Maybe there's another product or another program that they need to get in on. Still on the estimate, I don't know. We can guesstimate insurance and taxes and that kind of thing, but right now we're just going to kind of give you an ideal. And we're saying your projected estimated total monthly payment, PITI, is about $1,050 a month. This gives the consumer the opportunity to think about that number and make sure they're good with that number. Is there anything that they need to do to address or change that number? Or pick up with the lender, discuss with the lender. Then on the bottom of page 1, this is where it starts getting good. In the bottom of page 1, we tell the borrower what your estimated closing costs are, $8,054. And then we're going to give the borrower their estimated cash to close. Here we are within 3 days of loan application, and we're telling our buyer that you're going to have to bring about $16,054 to closing. Again, I can't stress how huge this is for the consumer, the borrower, to see this number now and not see it for the first time sitting at the closing attorney's office. I mean, I don't know, it's just always terrifying to me. My heart flutters a little bit when I think about those poor buyers out there that were presented this information without any time to think about it. And that's where TRID stepped in and said, okay, the best thing we can do to protect the consumer is to educate the consumer. And that's where the loan estimate comes in. Yes, ma'am.
Is it required, and I don't think it is, but is it, I guess it's a best practice, good to have the buyer to be pre-approved
Oh,
prior,
absolutely.
like a buyer's, what do you call it? What do they call it? A pre-approval letter?
Pre-approval or
Yeah,
pre-qualification.
yeah,
Kay, I'm not showing you a house until you've talked to a lender because I want to make sure it's not only worth my time, but I want to make sure it's worth your time.
mm-hmm,
If the home's occupied, we're asking the seller to leave the home. I want to make sure it's worth their time. So we're not showing homes until they've gotten that pre-approval.
yeah. Even for the seller, even as a seller's agent, um, I know I did this in South Carolina, not North South Carolina, but in Georgia, where I requested that, I'm only going to accept offers that have already been pre-approved.
Yep. And you may see showing instructions that says the buyer's got to pre-approve before they can see it. So if the seller, the
Happens a
listing agent
lot.
may put some specifics in there, but for me as a buyer's agent, and I'm going to say, let's just go ahead and agree, all of us on this call, there's a lot of time and energy that goes into showing a property. And I want you to make sure you're using your time and energy wisely. Guys, if the buyer's unwilling to talk to a lender to get a pre-approval or pre-qualification, I would question the sincerity of the buyer.
Mm-hmm.
The truth is there's professional home lookers out there. There's people that just want to go look at pretty houses all day and they will take advantage if the agent lets them. So I think that's a great ruling out. How serious is this buyer? And if they're not willing to talk to a lender, then I have to question. Tell them to go open housing on Sunday. That's what those professional house lookers can do, is go
Mm-hmm.
open housing. So these estimated closing costs and this cash to close. The next page is kind of the breakdown. I just want to show you here. They just don't tell you, well, here's a number that you got to bring to closing. Page 2 breaks down the things that they owe. We're going to break down and tell the borrower, this is how we came to that $16,050. So you got some loan costs, here's some initial escrows, that kind of thing. We're getting ready to look at this CD. We're going to do a full breakdown of this closing disclosure. What I want you guys to see from this page, again, we just don't throw a number at the buyer. Your cash to close is 16,054. We also give the buyer the breakdown of how we got to that number. And that's what this loan estimate is doing. So we have the loan estimate. Now let's pretend for a minute. We're going to fast forward to settlement. And TRID has another law, a disclosure law, and TRID requires that the lender send the borrower the closing disclosure. Anybody want to guess how many days prior to settlement?
3.
In TRID world, we said 3 is a good number to remember. So 3 days prior to settlement, the lender sends the borrower their CD. Their CD is going to look something like this. And this is all marked out because this was an actual CD of one of my transactions. So I didn't want to, leave any names or any information. So, but we can see here the final CD that went out 3 days prior to settlement. And again, the same kind of thing. Here's your loan amount, your interest rate. Can this stuff change? Is there a prepayment penalty? Yes or no? It's very clear, very easy for the consumer to see. 3 days prior to settlement, you now know to the penny what your monthly PITI is going to be for this year. You also know your cost to close and your cash to close. By the way, this was a VA buyer. So that's look how much she had to bring to closing. That was a good day for her. And I think that's what makes that veterans program so good, is for our eligible vets. It's easy to buy a home under that program. We look at the buyer's expenses and the seller's as well. In this example, this is the closing disclosure that we're getting ready to spend some time with. So we'll look at these different sections and how this thing works and what it means. I just want you guys to see on the closing disclosure, one of my favorite parts here. It tells the consumer, look, this is what I told you in the loan estimate. Now this is what I'm telling you at the final. And the burning question is, did this change? So 3 days from loan application, fast forward to 3 days prior to settlement, there's a lot that can change in between. So for the consumer to have this little breakdown, and again, it's okay when the numbers are less than expected. TRID has a problem when the lenders doesn't disclose all the figures or they don't disclose enough of the estimates. So always expect these numbers to be less than or smaller than, or at least the final numbers to be less than, and then break down to the parties debit. So we're getting ready to look at the closing disclosure. That's what we're getting ready to spend all our time on. But I just kind of want us to see, I think in the real world, I don't know how often you and I actually see the loan estimate. If your buyer chooses to share that with you, that's entirely up to them. But we do want to make sure that our buyers know to expect it. I don't necessarily need to see it, but I need to prepare them to expect it. Again, it's that communication with the lender. And then the closing disclosure that you and I are going to review for them. And let's talk a little bit more about. So we said the closing disclosure is delivered 3 days prior to settlement. And that 3 days prior to settlement is if it can be personally, if the lender can personally deliver that directly to the buyer. When it comes to delivering the final closing disclosure, this is one form of communication that you and I can't get involved in. The CD goes straight from the lender directly to the borrower. And if they can either personally deliver it or verify that it has been delivered, then settlement will happen 3 days prior. If it's got to be snail mailed, then we need to allow for 6 days. Most of what I've come across, I know a lot of our lenders use like a software that can show you when the buyer opens it, when they read it, when they sign off on it. And as long as they can do that within 3 days, personally deliver it to the borrower, then we're fine. Like I said, if we can't personally deliver it, then we have to allow for 6 days. When we count days, first off, let me say this. In TRID world, Sunday and national holidays don't count. So in TRID world, Saturday counts. And in TRID world, or in any time we count days, day one is always the day after delivery or receipt. So can you guys humor me for 1 second? I don't want today to be Saturday. Will you guys pretend with me for a second that today is Monday?
Sure.
Okay, so it's Monday. You get, or your borrower gets the CD today. That means Tuesday is day one, Wednesday, Thursday. If we get the CD on Monday, the earliest we can close is Thursday. Day one will always be the day after receipt or execution. Like we say, we count Saturday, we don't count Sunday. So if tomorrow were Christmas, then day one would be Wednesday, for example. This has to happen. And guys, as far as agents go, as far as our role goes, about a week or so before settlement, let your buyer know, have the conversation with your buyer that they are going to get a very important email from the lender. And if they don't address it on time, it will delay their closing. So let them be alert, let them know to look out for it so they can sign off on it so we can keep closing scheduled for Thursday. We can keep that on time.
I have a question.
Yes.
When it comes down, let's say for example, the contract stated that the buy will close within 30 days.
Mm-hmm.
And it does not close in 30 days. The buyer has not, because of the loan. As the seller, can the seller back out the transaction, or are they still committed?
Our
Because
contract,
go ahead.
our contract gives us a 7-day delay.
Okay.
So if we don't close in those 30 days, if the seller terminates on day 31, they're in breach. So we have a 7-day delay built into our contract. Absolutely. And we'll talk about what happens if it is delayed. What do the parties need to do? Closing disclosures. The consumer we're protecting is the buyer. Prior to TRID, buyers and sellers' numbers were on the same CD. Prior to TRID, buyers and sellers sat at the same settlement table at the same time. They were in the room at the same time. And once again, TRID said, that mess has to stop. How are we protecting the borrower if the seller's privy to all of their information? So another big thing TRID did is it gave us two CDs, one CD for the buyer, a separate CD for the seller. The other thing that TRID did is it said, look, I don't care if the buyer's in the room when the seller's doing their thing, because remember, we're not protecting the seller. I'm not going to say we don't care about the seller, but in TRID world, we don't care about the seller. But what we're not going to do is have the seller sitting in the room when the buyer's doing their thing. TRID separated the two. They really don't care if the buyer sees the seller's stuff. What they don't want is the seller to see the buyer's stuff. So you're going to have two CDs. Sometimes, you guys, attorneys will send both CDs to both agents at the same time. One email, two CDs. And our knee-jerk reaction is going to be to hit forward and send it to our buyers and or sellers. I need you to make sure that only the appropriate party sees their appropriate CD. Does that make sense? I need you to have a little bit of control here and just make sure the buyer sees their CD and the seller sees theirs. Even if the attorney sends you both, still make sure you keep those separate. Make sure the party only sees their applicable closing disclosures. There's some hefty fines for violating RESPA. So remember that $25 Target gift card or that chance to go on an all expenses paid cruise? I mean, gee, Julie, what's the big deal? It's only a $25 gift card. Okay. Violating RESPA, you're looking at about $10,000 fine per occurrence. How's that $25 gift card looking now? At least now you're at $9,975, right? $10,000 fine and possibly a year in jail. So guys, these TRID rules are real. They are very, very real. Again, they're lender laws, but you and I are working with the buyers that are working with the lenders. So for us to have this basic understanding, and the big thing for us is the kickbacks. What happens if I just accept that donut? That donut could cost you $10,000 and up to a year in jail. I can't answer to you whether or not it's worth it or not. It better be a good donut. You know what I'm saying? Like,
Okay.
even the best donut, I don't know, it's worth all that. If any questions on TRID or RESPA,
This is a lot.
it is.
A lot to
You
me.
guys, the other piece of that then is TILA. And the big thing about it is the advertising. And you guys will pick that up in 301 if you haven't done 301 yet. So they'll do a little refresher on TILA for you and what those advertising guidelines are. But what we're focusing on right now is just the closing piece of it. So with that being said, here we are at the settlement statement, also referred to as the closing disclosure. Again, we use them interchangeably. So with this section, I think first off, it's important that we start with what my responsibility is. When it comes to these closing disclosures, what's my responsibility as a broker? I'm not responsible for verifying that it is 100% correct. I can't be responsible for the accuracy of the whole thing. However, I am responsible for those items that I know or I should reasonably have known. This is what I'm responsible for verifying. So, for example, when I get a closing disclosure to review, the Lender has sent the CD to the borrower to satisfy our 3 days prior to settlement for TRID. The lender and the attorney have joined forces and they've all put their numbers on it. And what you and I get is what I refer to as the final CD. The final CD comes from the attorney. And the first thing I do when I review my closing disclosure is I pull out my sales contract and any amendments to the contract. Because things that I can verify are things such as purchase price, the due diligence amount, the earnest money deposit, seller pay closing costs, home warranty, all those negotiable items that come up on the contract. That's something that I can verify. We are getting ready to learn how to prorate taxes, HOA dues, rent. That's something that I can verify, make sure that those prorations are correct. We're going to talk about something called interim interest. If there's any unpaid invoices, a lot of our home inspectors, for example, will allow the buyer to pay for the home inspection at closing, at settlement, as part of their closing costs. So they'll do the home inspection, they'll provide the report, but the buyer's going to pay for it at closing. The home inspector will send you the invoice. So you can send it to the attorney so they can add it to the closing disclosure. That invoice has been in your possession. Can you now verify that that number is right, that that invoice is correct on the CD? Sure, because we had it. So these are the things that I know, or the key here is should reasonably have known. Example of things that I may not be able to verify. I probably wasn't privy to the conversation with the lender and the buyer about loan origination fees, credit report application charges, things like that. I probably wasn't privy to that conversation, thus I can't verify it for accuracy. What I can do is look at it to make sure it looks normal, that it doesn't raise up a red flag for me. And if it does raise a red flag, then I need to discuss it with the lender. You know, I'd say on average, for example, origination fees are like 1 to 3%. If I see an origination fee that's 9%, I'm calling the lender. Hey, what's up with this? You guys with me? So I can't check it for accuracy. I am looking out for those red flags. The more that you guys review of these things, you're going to see, you know, what you can and can't check. What was that, Jessica? I'm sorry.
I said, I bet the better we'll get, the more we actually do it. Because right now it looks
Exactly.
like a document I've never seen before, but
Exactly. And that's it's true. You know, you may have seen it once or twice, but not in this light. Remember, you have BICs. Remember, you have seasoned agents in your office. Some of you may even have compliance. So there's people with experience in your office that can help you review those first few closing disclosures to let you know what to look for. And never be afraid, because y'all, this is real estate. This transaction is different than the one I've ever done before. So 24 years down the road, you may come across something you don't know. It's still okay to go to your BIC. It's still okay to go to your peers. Again, the more sets of eyes we have on these things, the better chance for accuracy we have. And that's what all of us as the firm owe our buyers and sellers. So making sure those numbers are correct. The commission holds us responsible for what we know or what we reasonably should have known. So to break down the closing disclosure, there's a couple words you're going to hear a lot. So let's go ahead and define those words. And the words we're going to say are debit and credit. Our whole closing disclosure gives a breakdown. What is the buyer's debit? What is the seller's credit? What is the seller's debit? What is the buyer's credit? Both parties have monies coming in or out on their behalf. So a debit is a charge. A debit tells us that this is something that a party is responsible for paying at closing. Credit is money coming in on the party's behalf. One thing we're going to look at this afternoon is a little sheet I've prepared that breaks down the things that are typically debits and credits to buyers and things that are typically debits and credits to the sellers. So we can have a better understanding about what the buyer's charges will be, what the seller's credits will be, etc. We're also getting ready to talk about something called prorating. And to talk about prorating, to talk about interim interest, to talk about any of these math calculations, you guys had it pretty easy in pre-licensing. Every single month had 30 days. 30 times 12 is 360, right? Well, welcome to the real world. In the real world, we're going to use a real calendar, which means we may need to know the actual days of the month. We're going to use the 365. So there's the little rhyme. I don't know if you guys remember this from your childhood days. 30 days has September, April, June, and November. All the rest have 31 except for February. The other trick to help you remember the days, you guys know the knuckle trick to count the days? The knuckle trick. You count on your knuckle, and every time you hit a knuckle, it has 31 days. So if you start at the end, January has 31. In between the knuckle is February, it has 28. March has 31. In between is April, it has 30. May has 31. June, July, next hand, August. So every time you hit a knuckle, it has 31 days. In between the knuckle is not. It's 30, or if it's February, it's 28. Don't get bogged down on this. I just need you guys to know that we're not in cushy pre-licensing world anymore. And we may need to know how many days are in each month. And you're always going to do what the problems tell you. I've never seen a test question give you a leap year. So please don't worry about that. But if the test question gives you a leap year, now February has 29 and we have 366 days. We just had a leap year not too long ago, so it should be kind of fresh for us. So you guys are sitting there looking at me right now going, Julie, do I have to do this? Do I have to do this? And the answer is, because what was that A in old car?
Accounting.
Accountability, accounting. And guess what, you guys? As Becky told you, this is going to be the math on your exam. So you guys don't have to prepare these things in the real world. Did everybody just hear me? This tends to be a concern.
Yes.
I have to do this. No, everybody take a deep breath with me. You and I are not the ones preparing this. The closing attorney prepares, the lender prepares the closing disclosures. However, you and I have to be able to review it for accuracy. And the best way we know how to teach you the CD is we're going to do one together. We're going to work through one together to help you guys get ready for that class, and also to help best strengthen you that A and old car working with your buyers and sellers. So before we get into it, we got to do some, let's call it side math. So before we get into the CD, there's some side math we need to know. And the side math gets us into prorations and prorating. So first off, prorating is just taking a shared expense and making it fair between the parties. It's a shared expense. If you were buying my house today, is it fair for either one of us to be responsible for 2025 taxes? I only lived here 10 months. You lived here 2. Should either one of us be responsible for the whole year? No, it's not fair. So how do we make it fair? We take that shared expense and we prorate it. For our purposes on closing disclosures, those shared expenses could be this year's property taxes. If we negotiated an outside bill of sale, and in addition to buying my house, you're also going to buy my car, then we would prorate this year's personal property taxes as well. So property taxes, both real and personal, if applicable, will be prorated. Rent is a shared expense if applicable. and HOA dues if applicable. So we're going to look at the different ways to prorate, the different methods that we can take this shared expense and make it fair between the two parties. In North Carolina, when we prorate, we're always going to consider the seller responsible for the day of closing, which means the seller gets to pay today's taxes. The seller gets to pay today's HOA dues. And the seller gets to keep today's rent. The seller is responsible for the day of closing. I always remember it this way. When we woke up this morning, when our alarms went off this morning, the deed was still in the seller's name. So they get today. If everything goes according to plan, when we wake up tomorrow, the deed will be in that. We can't call on the buyer tomorrow, can we? The deed will be in the new owner's name, and that's when their responsibility will start. So let's start with prorating taxes. That's the big one to understand. That's the one that we see every transaction, because we know all properties are subject to taxes in North Carolina. I hesitate from words like always and never, because those are like really big words. But you're always going to have taxes on a closing disclosure because all properties are subject to taxation. So we're always going to have prorating taxes. And I got several different scenarios for prorating taxes that we're going to go through. So I'm going to throw something out there to you guys right now, and I'm going to see what you do with it. Is everybody ready?
Yep.
September 1st. What does the date September 1st mean to you guys? It's not my birthday.
First.
September
Oh,
1st?
it's the day that is that the day that taxes begin being due?
Taxes, for our purposes in North Carolina, are due and payable on September 1st. So when we're prorating taxes for our exam, we need that date. If closing is before September 1st, everybody with me? If closing is before September 1st, there's no way taxes have been paid. If closing is before September 1st, there's no way taxes have been paid because, as Jessica told us, the bill hasn't even come out yet. The bill isn't even due and payable. So scenario number one on prorating taxes, closing is before September 1st, and taxes are always unpaid. When I prorate, every time I prorate, I'm a visual person. Anybody else?
Mm.
I like to see. Yep. And I draw pictures because you know what? I've been given scratch paper. So if I've been given scratch paper, I'm going to utilize it. When I prorate, I always draw myself a timeline. And when I prorate taxes, the timeline specifically that I'm looking at is for the year, because we know the tax bill is for the year. What breaks or separates or divides the year is going to be the day of closing. So we've already decided closing is going to happen before September 1st. So let's go to closing on April 15th. The seller owns the property the front part of the year. The buyer owns the property the latter part of the year. All I've done so far, I learned I was going to prorate. And all I've done so far is I've given myself a visual about what it is that I'm prorating. If taxes have been unpaid, we go to closing on April 15th, taxes have not been paid. What that means is somewhere later in the year, the buyer will be responsible. If the buyer's responsible for paying taxes in the later of the year, the question with prorating is who owes who. So if the buyer will pay the entire or be responsible for the entire tax bill, who owes who at closing?
The seller owes the buyer.
The seller owes the buyer. And in CD verbiage, that shakes out to a debit the seller, credit the buyer. In CD verbiage, what we're saying is the seller owes the buyer. So the seller pays the buyer because the buyer's going to pay or be responsible for that bill later in the year. The party with the debit is the one that we calculate. So we know, ask yourself, draw your timeline, and then ask yourself who owes who. And once you decide that the seller owes the buyer, then we need to figure out how many days does the buyer or the seller owe the buyer. So there's 31 days in January, 28 in February, 31 in March, and then 15 in April, because we decided that the seller will be responsible for the day of settlement. So when you add up those number of days, what that tells us is that's how long this year the sellers own the property, what their tax responsibility is. You will be given the annual tax bill. So they will tell you the taxes for the year are X amount. We will then need to take the annual tax bill and divide by 365 to get our daily tax bill. So whatever the problem tells you are annual taxes, you divide it by 365 to get daily taxes. We know the number of days that the seller owned the property this year because we drew it out in our timeline. We have the number of days times the daily taxes, and that's going to show up as a double entry on the CD. Double entry telling us we're going to see it twice. Debit the seller, credit the buyer. In a sense, what we're doing, the seller is giving the buyer money, but they're not actually handing them a check or handing them cash. We're going to hash it out on our closing disclosure. Guys, this is that in this case, this is that much less that the buyer has to bring to closing. That's that much that less that they have to bring. So when the bill comes due later in the year, the buyer doesn't have to worry about going back and trying to collect from the seller. The buyer's already received the seller's portion of taxes at settlement. If you can, always think of settlement. We're finalizing or settling everything between the buyer and the seller. Once we're done, we want the parties to be done unless they've agreed otherwise. So we find the number of days, times it by the daily taxes, and that gives us our prorated amount for the CD. Debit the seller, credit the buyer. You guys have scratch paper and calculators and all that good stuff in front of you or nearby?
Yeah.
I'm okay if you use your phone today. I know we didn't have a lot of time. Use your phone today. Just remember for your test, you can't use your phone. So let's do this. Scenario number 1. You guys take a minute, take your scratch paper and your calculator, draw it out. I'll give you just a few minutes to look at it, and then you and I will come back together and talk about it. about another minute, and then we're gonna talk about it. So we're given some information. I know my annual tax bill. I know when closing is, and quite frankly, that's all I need to know to prorate. I need to know when and how much. Question wants to know what's the tax entry. My mind, you guys do this anyway, however you see it. Please, there's no wrong way. That's a fun thing about math. There's like several different ways we can all get to the right answer. So I don't care how you get there, just get to the right answer. In my mind, when I prorate, the first thing I want to do is draw it out. The first thing I want to do is give myself a visual so I can see what it is that I'm prorating. And because I'm prorating annual taxes, I know my timeline is an annual line. And what divides or separates the timeline is closing, which we know is July 18th. The seller owns the property the front part of the year. The buyer will own the property the latter part of the year. We know taxes are unpaid. Maybe the problem tells you this, maybe they do not. But you and I know they're not paid because the bill, they're not even due yet. And that's why that September 1st is very important in prorating taxes. So we know that the tax bill is unpaid, which means, like we said, the buyer's going to be responsible for the whole bill later in the year. And if the buyer's responsible for the whole bill, the question I want you guys to ask yourselves and make sure you write it down is who owes who? And as we determine, the seller owes the buyer, which in CD verbiage shakes out to debit the seller, credit the buyer. The party with the debit is the party I got to calculate. So we're going to calculate the seller's days. Did y'all do a lot of counting on your fingers for this? It's okay. It's okay. Your fingers are a good tool to help you do math. So I got 31 days in January, 28, March, April, May, June, and then 18 days in July. This is the seller's responsibility for this year. How many days did you guys get?
199.
We got 199 days that the seller owns the property, 199 days of taxes that the seller owes the buyer. Questions on the number of days? Now we get to figure out how much. They tell me that my annual tax bill is $4,900. We know there are 365 days in the year. So when I take 4,900 divided by 365, I get 13.425. Yep. When you guys are rounding, go out at least 3 decimal places until you get to the end. So at least 3. So I'm getting taxes are $13.43 a day. Every day this year. $13. It's a 5. We know the seller's responsibility is 199 days. So when I take $13.43 times 199, we get debit the seller, credit the buyer. Seller owes the buyer for $2,671.58. $13 and some change a day times 199 days. It'll show up twice. It's going to show that same amount will show up twice.
Debit.
Once as a debit to the seller, and again as a credit to the buyer. And of course, we're getting ready to look at where all this stuff goes, one thing at a time, right?
Mhm.
Questions on how we got this proration, questions on anything. So that was one scenario. Closing is before September 1st. Taxes have not been paid. We good? Can I erase?
Mhm.
Perfect. Other scenarios, I got 2 more scenarios for prorating taxes. And those scenarios are going to be when closing is after September 1st. Now, the problem has to tell us whether or not taxes have been paid. I'll say that again. If closing is after September 1st, the problem will have to tell us whether or not taxes have been paid. There is no knowing like before September 1st. So the 2 other scenarios to talk about, closings after September 1st, and scenario number 1, taxes have been paid. We're going to closing after September 1st, and the seller has already paid the tax bill. So let's see what that looks like. Annual taxes. Drawing my timeline. And now we're going to closing after September 1st. And let's say we go to closing on October, I don't care, 27th. Okay. So again, what separates the timeline is the day of closing. Seller owns the front part of the year. Buyer owns the latter part of the year. The problem tells you that closing is on October 27th. And the problem tells you that taxes have been paid, which means the seller has already paid the entire year. So the question we ask ourselves now is, who owes who?
The buyer owes the seller.
That's right. Now we got to get the buyer to reimburse the seller for the taxes that they've already paid. And CD verbiage, that shakes out to debit the buyer, credit the seller. The seller's already paid. They're not going to live there the whole year. They want somebody to reimburse them. So now the buyer's up. The party with the debit is who we calculate days for. So now we're going to figure out days for the buyer. Remember, the seller's responsible for October 27th. The seller gets to pay that day's taxes. So the buyer's responsibility will start tomorrow and go through the end of the year. The buyer's responsibility will start the day after settlement, the day after closing. When you guys are counting forward on the timeline, I need you to be really, really careful, because it's really easy to look at that and say, well, there's 3 days left in October, but you've just missed a day. When you're counting forward on the timeline for the rest of a month, I actually want you guys, I got a highly sophisticated method to make sure we get it right. Are you guys ready? I'm getting ready to blow your minds. I want you to count it out on your fingers. So when we're looking at the rest of October, count October 28th, 29th, 30, and 31. There are 4 days left in October, 30 in November,
1
and
plus
31 in December. 28, 29, 30, 31.
36. 40.
It's so easy, you guys, to be like, oh, 3 days left in October. And if you did that, you just missed the whole problem. Not because you don't know what you're doing, but because you didn't count days right. So take the hard part out of it and just count it out on your fingers, please. So the buyer owes the seller for the 4 remaining days in October, the 30 days in November, and the 31 days of December. Again, we take the annual tax bill, divide by 365 to get daily, times it by the number of days, and then we see our double entry, debit the buyer, credit the seller. Questions on this scenario before we look at our practice problem? After September 1st, taxes have been paid. Can I erase? We're good? All right. I can't have all the fun. Your turn. Take a few minutes. We'll come back and talk about it.
Okay.
Got another minute and then we'll look at it. Let's see what we got. Scenario number 2. Closings after September 1st. Have taxes been paid or not? I don't know. The problem needs to tell me. So after September 1st, we see it's the 24th, and ooh, looky there. The problem tells me that taxes have been paid. I know I'm going to prorate. First thing I want to do, just draw it out. I want to see what it is that I'm working with here. Annual taxes mean that I'm looking at an annual timeline. And what separates the annual timeline is the day of closing. So that's going to happen on September 24th. Seller owns the front part of the year. Buyer owns the latter part of the year. Problem tells us that taxes have been paid, which means the seller's already picked up the whole tax bill. So now the question we always ask ourselves when we prorate is, who owes who? I see mouths moving, but you guys are all muted. So I think what we're saying is the buyer owes the seller. Is that what we're saying?
Yes, because
Yes.
it's after
Uh-huh.
September 1 and everything was paid.
I saw it. So buyer owes the seller, which means in CD verbiage, what we're going to say is debit the buyer, credit the seller. The party that we count is the party with the debit. The buyer's responsibility starts tomorrow
Okay.
and it goes through
December
the end of the year.
Mm-hmm.
For the rest of September, we got the 25th, 26th, 27, 28, 29, and 30. Is it not super easy to look at that and see 5 days? Don't do that. Count it out. So I got 6 days in September,
Mm-hmm.
31 in October, 30 in November, 31 in December. How many days does the buyer owe the seller for?
98 days.
98 days. Yep, buyer owes the seller for the rest of the year, the time that they own the property, for 98 days.
Mm-hmm.
The previous problem, we already calculated daily taxes, so they don't make us do that again. So as a reminder, we had $13.43 a day. We know the buyer owes the seller for 98 days. So if we take that 98 days times $13 and some change a day, how much does the buyer owe the seller? And we'll see an entry for $1,315.65.
$1,265.
I have questions.
Somehow I got $1,315.16.
I got 62 cents.
So 13.425 times 98. It's probably just an error in rounding
Oh,
somewhere.
Okay.
So just make sure you're going out 3 decimal. Guys, listen to me. Listen. You're not going to get a problem wrong on rounding alone. So in
Okay.
other words, the answer choices aren't going to be 65 cent, 16 cent. They're not going to be that close that if we round different. However, mark my words, I can almost guarantee you there's going to be an answer choice off by $13.43, banking on you not counting days right. So don't worry about rounding. If you got a few cents different from me, it's probably rounding.
Mm-hmm.
What I
Okay.
do want you to worry about is getting the days right.
Mm-hmm. I got it now.
So how do we do with that one? Bryson, how you doing over there? Doing good?
Yeah, I'm good. I just when you get your 267, do you subtract that from 365, right?
Say
Because
that again?
it's
To get this,
from September 24th, it's 267 days that the seller pays for.
So then we have 365 minus how many days? 98 should
267 I
be
got, and then you get 98.
267.
And
Yep.
then you multiply that by your daily to get that one.
If that, yeah, if that's how you see it. So if you want to do the sellers and then back out that way, or if you want to calculate the buyers, what I need
Oh,
to
I see
know is
what you're
what the
saying.
buyer
Okay.
owes the seller.
Yeah, I got it.
So that's why I calculate the buyer's days.
Yeah, thank you.
Of course. Proration scenario number 2. After September 1st, taxes have been paid. Questions?
mm-mm.
Tax proration scenario number 3 and final tax proration scenario. Closing is after September 1st, and the problem tells you that taxes have not been paid. So after September 1st, the seller has not paid the taxes. I'll be very truthful with you guys. In the real world, when you go to closing in November and December, this is more than likely what you're bound to see, the scenario that you're going to see in the real world. The closer you get to the end of the year, when taxes are unpaid, this is this scenario. So now we still need to look at each party's responsibility. We're still prorating taxes. So we're still going to draw out our little timeline. And I think I said, was it October 27th? It doesn't matter. That's the date we're going to go with again. After September 1st.
It was October 27th.
Is it the 27th? Thank you.
Yep.
Seller owns for the front part of the year, buyer owns for the latter part of the year. Taxes are unpaid. This is what's going to happen. Nobody owes anybody. The parties are not going to share this expense. If taxes are unpaid after September 1st, the attorney's going to collect the seller's portion from the seller. They're going to collect the buyer's portion from the buyer. And then the attorney is going to pay this year's tax bill on behalf of the property. Remember, in the real world, this is closing on like December 20th. We know the end of the year is coming. We know the tax bill is due. So the attorney is going to collect from both parties and pay the tax bill on behalf of the property. So unpaid after September 1st, what we're going to do now is referred to as a double debit. The seller pays their fair share. The buyer pays theirs. So the seller's responsibility is January 1st to the day of closing. The buyer's responsibility is the day after closing to the end of the year. Each party pays their fair share, and then the attorney sends the tax bill on behalf of the property. Debit the seller and debit the buyer. When I do these, because we're getting closer to the end of the year, we know we're after September. When I do these, I find it easier to calculate the buyer's numbers because they're the shortest amount of time. They just have those few days left in October. So we had the 28, 29, 30, 31. So I got 4 days in October, 30 in November, and 31 in December. So the buyer's responsibility is going to be for 65 days at 28, 29, 30. Yeah, so I did 4 plus November plus December. So the buyer's responsibility is for 65 days. And then I think what Bryson was saying earlier, to calculate the sellers, we instead of, not unless you want to count January, February, March, April, May, etc., we could take 365 minus, and that tells us that the seller's responsible for 300. I tend to find it easier to calculate the buyer first, like I said, because they have the shortest amount of time. And usually what I do, because then we'll take the daily taxes times 65, and then you can even take the annual tax bill minus that, and whatever's left belongs to the seller. But between the two, they will be responsible for the tax bill this year. It's called a double debit. Debit the seller and debit the buyer. Questions on that? Y'all know what's next, right? Big fun.
Right.
Here you go. We'll talk about it. Take a few minutes with it. Double debit.
Mhm. Mhm.
Give that another minute. All right, so third prorating tax scenario after September 1st, but now the problem has to tell you if taxes are unpaid or not. So we know closing's happening on the 22nd, and the problem tells us that those taxes are not paid. So first thing I always recommend when I prorate, draw it out. Take the problem. I've done math tutoring, y'all, for pre-licensing for 15 years now. And probably one of the number one questions I get in math tutoring is I don't know how to take the information in the problem and interpret it. How do you take that and put it in math? And my solution, if I can turn that information into a picture, that's one way to help me see what the problem's getting at. So we know we're going to closing on the 22nd. Seller owns the front part of the year, buyer owns the latter part of the year. Taxes have been unpaid, which means buyer's not paying seller, seller's not paying buyer. They don't owe each other money because no money has changed hands for taxes. So instead, we're going to have each party pay their fair share. And again, for me personally, when I do these, I like to start with the buyer because it's less to count out. So I got, responsibility is going to start tomorrow and go through the end of the year. And when I count out the rest of October plus November plus December, how many days are we getting for the buyer?
I got 70.
I got 70.
Bryce and Kay got 70. So we figured out 23rd, 24th, 25th, 26th, 27, 28, 29, 30, 31. I got 9 days left in October, 30 in November, 31 in December. Same tax bill, so we know the annual taxes are the same, $13.43. I'm sorry, daily taxes are the same of $13.43. We know the buyer has 70 days. So when we take that 70 days, we see that the buyer's responsibility for taxes this year, debit the buyer, is $939.75.
Got it.
And then for me, I like hearing that. And then for me, now that I know the buyer's responsibility, I can take the annual taxes minus what the buyer owes. And that tells us whatever's left is for the seller. Or if you want to count it out, works for me too. As long as we all get to the buyer and the seller's responsibilities. So we'll debit the buyer $939.75, debit the seller $39.60.25. How'd we do?
Good on
Good.
this one.
Good.
Good.
Good. And remember, guys, we're recording. So you have the ability to go back. You know, the beautiful thing about the recording is on the recording, you can like rewind me, you can pause me. That doesn't work in person. So you you have more control over me on the recording. So the three different tax proration scenarios all revolve around that September 1st date. We have other proration scenarios to look at. We also need to take a break. Let's just take a break. So we need to take 10, synchronize. I got 231. So let's come back at 241 and we'll talk about some other prorations.
Oh no, I missed what time we were.
All right. So we talked about prorating taxes. And there's some other things that we might see prorated on the closing disclosure, if applicable. And so we're not necessarily needing the math, just kind of understand the concepts, because the math is the same, but understanding how different things could look a little bit different. And another thing, if applicable, that the parties will prorate at settlement are HOA dues. HOA dues can be monthly, they can be quarterly, they can be semi-annually, they can be annually. The problem has to tell you. And what differs here with HOA dues, like taxes are always annual. If HOA dues are monthly, for example, then your timeline is going to look a little bit different. So if this were October HOA dues, we'd be looking at October 1st to October 31st. So the big thing that's different with HOA dues is your timeline is going to look at it a little bit differently. They're not going to give you quarterly or semi-annually for your test. That's just too daggone mean. But they may give you monthly, they may give you annual. I only got 2 scenarios with HOA dues. If we get to settlement and HOA dues are not yet paid, then the attorney is just going to do a double debit. They're going to collect what the seller owes. They're going to collect what the buyer owes. And then the attorney will pay that HOA due on behalf of the property. If we get to closing and the seller's already paid the HOA dues for this month or this year, then we're going to do buyer owes the seller. We're going to do a debit the buyer, credit the seller. So again, the problem will have to tell you with HOA dues is in addition to, is this monthly or is this annually? Questions on HOA dues? The third thing we could see prorated, if applicable, is rent. So first off, for our purposes, unless you're told otherwise, rent's due and payable at first of the month. So we know going into the month, today's the first of the month, tenant pay the seller rent today. And rent is always paid in advance. So when our tenant paid rent today, they paid for November's rent. So again, what we're prorating would be a monthly timeline. And the other thing that's different about this, remember, let's see, let's pretend we're going to closing on, I don't care, November 10th. If we go to closing on the 10th, remember, the seller is responsible for the day of settlement. So since the sellers already collected rent, they collected rent on the 1st, the seller will get to keep today's rent. So the proration, debit the seller, the party with the debit always gets the seller owes the buyer, the party with the debit we always calculate. So the seller will keep rent for today, through the 1st of the month for today. And they will owe the buyer for the rest of the month, whatever's left. Today, the tenant belongs to the seller. Tomorrow, the tenant belongs to the buyer. And then when December 1st rolls around, now the buyer's the owner, the tenant will just pay them directly. Seller's no longer involved. The proration, like I said, you can always bank on seeing taxes, even in the real world. You can always bank on seeing taxes, HOA dues if applicable, personal property taxes if applicable, and rent if applicable. Any questions or comments on prorating? I feel like you guys did really well with that. And that does me good. So again, if you have questions between now and next Sunday afternoon, don't hesitate to reach out to me. I definitely want to help you guys. I want to make sure we get you the information you need. I'll be honest, I don't care about you passing the test. I know you do. But it's more important that we get the information so we can use it in the real world with our buyers and sellers. Obviously, getting past the test is an added bonus, added benefit. The other kind of pre-math before we get to the CD that we need to learn and discuss is something called interim interest. And please make a note for me, because interim interest is just prepaid interest. The buyer is getting caught up on their interest payment. Interim interest is not a proration. The seller has nothing to do with this. Interim interest is the buyer getting caught up on the interest that they owe their lender. So what do I mean by that? If I were to look at a different timeline, interim interest, or interest, I should say. Let's see, let's go to closing on, let's go back to closing on October 27th. That was a date that just stuck out to us. So we're going to go to closing on the 27th. And if I look at the closing timeline, whenever the borrower originates a new loan, they don't have a mortgage payment on November 1st. So if they originate the loan on October 27th, they're not going to have a mortgage payment on November 1st. Their first mortgage payment is going to be December 1st. So whenever you originate a new loan, you get to skip the first. We're going to say mortgage payments are due on the 1st of every month. The reason being, you'll remember that when you make your mortgage payment, it consists of 4 pieces: principal and interest, taxes, and insurance. The principal and interest amount is the same for the life of the loan. That amount is the same. It never changes for as long as you have that loan. And it charges you for a full month. And interest is paid in arrears. Always remember the arrears. Where's your rear end? Everybody can look with me. Your rear end is behind you. So if you were to make a payment, you originated the loan on the 27th. If you were to make a payment on November 1st, you'd be paying all of October's principal and interest. Is that fair? You didn't even pick up the loan until the 27th. So you're going to skip the first. Your first mortgage payment will be December 1st. And when you make that payment, you're paying November's interest, because interest is paid in arrears. When you make your payment on January 1st, you're paying December's interest. You're always paying interest for the month behind you. Interim interest is getting the borrower caught up. When does the lender, if they originate the loan on October 27th, when does the lender want to start collecting interest? Today, October 27th. So we're going to charge the borrower for the day of closing to the end of that month. We're going to let the borrower get caught up on their interest payment. Interim interest is always the day of closing to the last day of that month. And again, we're counting forward, so we're going to count it out on our fingers: the 27, 28, 29, 30, and 31. We would charge them for 5 days. Never ever go into the next month. So because interim interest is charged in arrears, what the lender wants to do is collect this prepaid interest from the borrower for the rest of that time in October, so they can get caught up on their interest payment. So it's money that they owe the lender, and all they're doing is getting themselves caught up for the rest of the month of settlement. If you go to closing on the last day of the month, then they would only have 1 day of interim interest. If you go to closing on the 1st, they still skip the first typically. You got to give them a full month. And since closings generally don't happen in the full month, this interim interest allows them to get caught up on their interest payment. So to calculate interim interest, we're going to first figure out the number of days left in the month. Count the day of closing, because this has nothing to do with the seller. This is between the buyer and their lender. So we count the day of closing to the last day of that month. Then we got to figure out the daily interest rate. So we're going to take the loan amount, whatever the lender's bringing today for closing. When you take the loan amount times the interest rate, you get annual interest. And we need to divide that annual interest by 365 to give us daily interest. So we first figure out the number of days. Then we figure out how much it is per day. Loan amount times the interest rate gives us annual interest. Now that we know the number of days and the daily rate, we just multiply them together, and that gives us a single entry item on the CD, which is a debit the buyer. Buyer owes their lender for their prepaid interest, also known as interim interest. They may throw loan amount at you, sales price, and listing price. What's the only number I care about? Through the eyes of the lender, all they care about is the loan amount. All lender calculations are on the loan amount. So don't be distracted by the distractors. The lender cares about the loan amount. Do we have the steps in front of us? You guys know me well enough already to know what's coming next, right? Here you go. We'll talk about it. Take a minute with it, see what you can do. got another minute, and then we'll talk about it. Let's see what we got here. I got a buyer that's agreeing to purchase a home for 245. They're getting a loan for 200, 5.25% interest for 30 years. They're originating the loan or going to closing on July 18th. We know the lender's going to charge interim interest because they want to collect interest as soon as they originate the loan. So we're tasked with finding out how much the buyer will pay the lender in interim interest. My first question to you guys, if we're going to closing on July 18th, when will the buyer's first mortgage payment be due? Everybody's on mute. I see Mel's moving.
September the 1st.
So they don't have a payment on August 1st. We skip the first. So there is no payment on August 1st, which means, Kay, you're right. Their first payment will be due on September 1st because interest is charged in arrears. So that payment in September 1st will cover August's interest. Everybody good with that so far? That's the gist of interim interest. We know the lender's going to charge the buyer for interest from the day of closing to the last day of that month. And January, February, March, April, May, June, July is a knuckle. So there are 31 days in July. So we will charge the buyer, calculate for the buyer from the 18th day of closing to the last day of that month. How many days did you guys get?
14.
14 days. We're good? We're all on the same page? Perfect. So we know how many days. Now we need to figure out how much. And to figure out how much, we take the loan amount times the interest rate. Loan amount times the interest rate gives me annual interest, which is a whole bunch. But I need to break that down to daily. So when I take my annual interest and divide it by 365, I get $28.77 a day. We already know the buyer owes for 14 days. So at closing, the lender's going to collect $402.74, and that's going to show up as a debit to the buyer. Interim interest. All we're doing is getting caught up. Now the lender's happy because they've received interest through July. They will collect August interest when they make that first payment in September. Questions? Interim interest. Can I erase? You guys good? You got it? Okay. So next, we need to look at the CD. But before we do that, before we get into that, I just kind of want to finish this section up as a reminder of what our responsibilities is. And you guys see license law 93A-6 down there. Again, I don't need you to know that number. Don't memorize that number. But what you do need to know is that 93A-6 is the law that says these are the things that the Real Estate Commission can discipline our license for. And when we look at this law, I mean, it gives us a nice little bullet list of things that they can discipline. And failure to review our party CD for accuracy could be seen as a disciplinary action by the North Carolina Real Estate Commission. So it's definitely our duty. It's definitely part of our responsibility. And specifically my responsibility with these CDs, I have a duty to make sure to review it for accuracy, to make sure that my parties receive an accurate CD. Buyers and sellers don't know how to calculate these things, you guys. They're relying on us to help them make sure that their bottom lines, we want to make sure that what our buyer has to bring to closing and what our seller gets from closing is accurate. As we said earlier, and I'm not trying to be funny, I'm just trying to be very real with you guys. It's not a matter of if you find a mistake, it's a matter of when, because remember, attorneys, lenders, paralegals, we're all human. You guys ever make a mistake every once in a while? They do too, right? So we have a duty when you find a mistake, make sure you've notified all parties, the lender and the attorney of that error. This is not the time to be shy. If you're not sure, before you call anybody, get with your BIC, get with the seasoned agent, get somebody to verify. But a lot of times it may not even be calculations, it's just careless entry. We reviewed one a couple months ago, and I don't know how, but somehow the buyer was charged twice for the home warranty. How? I don't know. But had we not caught it, and I think eventually it would have worked out, but it's easier if we can catch these things up front before we get to that final. So make sure that you're looking at it for accuracy. And when you do find a mistake, notifying the parties. You and I are going to communicate with the lender. And one thing we're getting ready to learn is that any money, or shall I say all money, that changes hands as a part of this transaction has to be on the closing disclosure. So when we pay the appraiser or the home inspector, all that money that changes hands has to show up on the closing disclosure. And you may have a case, maybe it's first-time home buyers, and maybe mom and dad have offered to pay for the home inspection. They're so proud of little Johnny for getting his first house. Let's pay for this home inspection. It's okay for mom and dad to pay for the home inspection. I just need to let the lender know so they can put it in the appropriate place in the closing disclosure. Even though mom and dad are paying it, it's still money changing hands as a part of this transaction. So when you hear mom and dad say, oh my goodness, we're so proud, we'll pay for that home inspection, just let the lender know so they can put it in the appropriate place. The other big thing for us to understand is if we don't report it, if we don't review it, if you say, well, I didn't get it, okay, they know better, you guys. They know you're going to get it. When you get it, you have a duty to review it. When you find a mistake, you have a duty to report it. Failure to do so under license law 93A-6 could be cause for disciplinary action. It violates that old car duties that we owe our clients. Any questions? Comments so far? So you guys got the email from Lane for this class, and within that email was a blank closing disclosure. Do you guys, as Becky said, for your exam, you can have a blank CD. Do you guys have the ability to print between now and next Sunday? Okay. So I want you guys, you're welcome to print out as many of those CDs as you want to practice. We're gonna do one tomorrow in class, so if you want to print one tonight and work along with me tomorrow, I would recommend that. But the big thing is that you guys have the ability to print one of those to have it for your exam. So thumbs up, we're good. Everybody's, if we were in person, I'd be handing you paper right now, but we're not, so I'm not. So I need to make sure you guys, and you can have blank paper as well, scratch paper in addition to the CD. So this is the CD you guys got. Well, mine has highlights on it just to point out some things. But this is what you guys would have gotten from Lane. And before we pick up calculators, before we really start looking at this, we need to just look at the blank CD itself. As we start going through this, a lot of what you guys are going to be dealing with at first is determining what goes where. As Jessica said, the more you review these things, the more times you see it, you're going to know what goes where. But these are challenges you're going to have for your test. Where does the lender fees go? Where does the home warranty go? Stuff like that. So I think the more time we can spend with the blank CD, the quicker we can get through the test because we're not hunting and pecking and looking. So to introduce you to the closing disclosure, it's 2 pages. Page 1 is debits to third parties. You may want to jot that down. Page 1 is all debits, never credits. To third parties. Hear me. The parties to the transaction are the buyer and the seller. Everybody else is a third party. It's funny to think of ourselves as a third party, but we are. So when we talk about the parties are the buyers and the sellers. Everybody else is a third party. So everything we see on page 1 is monies that buyer and seller owe those third parties. You see the highlights here. I have some columns. I got a borrower paid, things are going to pay at closing, things that'll be paid before closing. We mentioned earlier that the appraisal fee is due before the appraisal can be done. That's something that'll be paid before closing. Even though it's paid before closing, it's money that changed hands as a part of this transaction, which means it still has to show up on the closing disclosure. It would just show up specifically under borrower paid before. You guys see what I'm saying with the different columns here? We go through that same little exercise with seller paid at closing, seller paid before closing, and then we have things paid by others. So when mom and dad paid for the home warranty, mom and dad would be considered others. What you and I are going to work on, what you and I care for the exam, is the paid at closing columns. So we're going to focus specifically on the borrower paid at closing and the seller paid at closing. Then we look at the CD and we see the different categories. And the first big section here are loan costs, various things from the lender. And you can see it's broken up into, A, B, and C. A is your origination charges, so your loan origination fee, discount points, application fee, things like that. B is your services that the borrower did not shop for. The borrower has no control over who does the home or the appraiser. That is something that the lender orders. Same thing with the credit report fee. And then C are services that the borrower did shop for. So there's our closing attorney, deed preparation, etc. The way this is set up, well, let me say that in a second. I'll come back to that. As we come down a little bit, still on page 1, we got some other costs. So we got some cost to taxes and other governmental fees. There's our recording fees, the seller's excise tax. There's some prepaid things we're going to talk about, including our prepaid interest, which is also known as interim interest. So we'll charge the buyer for that there. Some initial escrow payments. The lender's going to want to collect some money at closing to fund the borrower's escrow account. We know each month they send in their payment is going to be a 12th of this year's taxes and a 12th of this year's homeowner's insurance. But to start the count, to originate the count, the lender's going to collect some money up front at closing. And we'll see that under G is in Ginny. H then is other. You and I belong under other. There's our broker commission, there's your home inspection, home warranty, some kind of courier fee or wire transfer fee, etc. In the real world, you have blank spaces here if you need to add something in, another fee or something. The CD in the real world is very similar to what we're looking at. It's just some attorneys may call things differently. But again, the more you review it, the more familiar you get with it, and the better equipped you are to assist your buyer and seller. I'll come back to this stuff in just a minute. I just kind of want to introduce you to the different categories for now. Then we go over to page 2. Buyer stuff is on the left. Seller stuff is on the right. And page 2 is where we hash out all of the buyer's debits and credits on the left and all of the seller's debits and credits on the right. So when I do these, I like to focus just on one side at a time. And you can see K as in Kelly is due from the borrower. So K as in Kelly is all of the borrower's debits. Everything they owe to purchase this property. L as in Larry are all of the buyer's credits. So K gives us all of their debits. L gives us all their credits. K minus L tells us how much your buyer has to bring to closing. And then when we look at the sellers, we're going to do the opposite. M as in Mary is all of the buyer's or seller's credits, everything due to the seller. N as in Nancy is all of their debits. So when we start doing these for real, I'm going to encourage you guys to write D's and C's on your blank CD for your exam so we can see what are the buyer's debits and credits, what are the seller's debits and credits. Most of the time for the sellers, their credits are bigger than their debits. That tells us how much your seller's going to get from closing. Could you have a case where the seller's debits are more than their credits? Sure. That means that's money that the seller owes. The seller's underwater. When their debits are more than their credits, it's money that they owe. So let's go back up and look more at what we're heading at. Again, it's hunting and pecking. It's looking for stuff. So for your exams, what I need you guys, what we're going to focus on is the borrower paid at closing column and the seller paid at closing column. And when we do this, probably tomorrow morning, when we do this, we're going to go through and we're going to fill out the various fields. And when we get everything filled out, the bottom of page 1 is J. And J is the total of everything on page 1. J, as you can see the little highlights here, J is going to tell me that what are the buyer's total debits to third parties and what are the seller's total debits to third parties. Everything on page 1 is a debit. You're not going to see a credit on page 1. So the bottom of page 1, J, we're figuring out what are the total debits to third parties. And we need to take these numbers from J and we're going to put them over to all of their debits on page 2. So as we said, this is all of the buyer's debits. And this is, I'm trying to get everything on one screen here. And this is all of the seller. So if we look at this, debit and debit. And you will notice within the debits, one thing we're going to plug in is what we calculated on page 1 under J. So once we calculate page 1, once we come up with that J, then we need to take that number and put it here on page 2, because K is all of the buyer's debits, including what we got from page 1. N is all of the seller's debits, including what we got from page 1. So when I look at page 2, I like to do some origami with my paper. I don't know if you guys have been able to print it yet or not, but you can see I got one in front of me and you can see kind of what we're looking at. You can fold your paper 2 different ways. I've recently learned this and it's the most adorable thing I've ever heard. You can fold your paper either hot dog or hamburger. So you can fold your paper either long, and that is precious. You can either fold your paper longwise or you can fold it shortwise. So when we're looking at page 2, the benefits of the debits and credits is so we can see what it is we're talking about. And I'll show you what I'm saying. So let me just put this back up here. So you guys, I got debit and credit for the buyer. I got credit and debit for the seller. So when we fold our paper hot dog, we're looking at just the buyers on the left. And we calculate all their debits, we calculate all their credits, and then the final number down here is asking us for the buyer's cash to close. How much debits minus credits will it cost them to obtain this loan? Turn your paper over, and on the right side, we have the sellers. Credits minus debit. And when we get to the bottom, we're asked how much is the seller gonna get, hopefully. When we fold our paper hamburger, we're looking at the buyer's debit and the seller's credit, the buyer's credit and the seller's debit, and that helps us with the prorations. So if we come up with a proration that's a debit the buyer, credit the seller, we're at the top part of the page. When we're looking at a proration that's a credit the buyer, debit the seller, we're at the bottom part of the page. So it's all about coming down to their debits and credits and those final calculations. And I'm going to have you guys, if you can, come tomorrow with a blank piece of paper, and we're going to fold our paper and all kinds of origami with it. Good times, huh? And bottom line, you guys, as Becky said, you got 4 test questions. 2 of them want to know. Here it is. 2 of them want to know what's the cash to close from your buyer and what's the cash to your seller. So for 2 test questions, you're going to have to do both sides of the CD and figure out what your buyer has to bring to closing and how much is your seller going to get. The other 2 questions, they're going to give you like a snapshot of a CD, and they're going to ask you to figure out what's wrong. Something is incorrect. So you're going to have to look at it and determine what's not right. And if I'm being very honest, those 2 test questions are the real world applications. It's what we're doing in the real world when we review these things to look for what's wrong with the CD, to look for those errors. So you'll be given 2 problems that have something wrong, and you'll need to identify. So this whole CD you're doing is only 4 test questions out of 25. The other piece in understanding this evening, I'm going to send you the link to our Google Drive. And one thing I have in our Google Drive is a sheet that's called Who Pays for What at Closing. You guys are welcome to use this up until your exam. You cannot use this for your test. But in helping you better understand the closing disclosure, this gives us the breakdown of what are the things that are the debit to the seller, what are the things that are the debit, the credit to the buyer. I hesitate to call this your little cheat sheet because you can't use it for your test. So let's call it your cheat sheet until you get to your test. And having an understanding of who's responsible for what, I'm not going to lie, is the key to getting these CD problems right. So as we're going through this, and we're going to talk about it, but as we're going through this, I suggest spending time with this as you guys are practicing some at home, etc. Spending time with this, because once you get this, the rest of the CD just kind of falls right into place. You have this available. You're welcome to print it out if you want to have it as a reference in the real world. You're welcome to, well, you will have it available when I send you the Google Drive link later today. So what this gives us, we're going to break this down into specific each party's debits and credits. And we're going to start with looking at the seller's debits. These are things that are typically paid by the seller unless the problem tells you otherwise. So the seller, unless we're told otherwise, will be responsible for the commission, paying our commission. If the problem says the buyer's agent's commission, then the buyer's going to pay, or the buyer will pay for that. But usually it just says commission. So we'll know that the seller pays for that. The seller pays to have their deed prepared. The attorney charges a deed preparation fee. That deed preparation fee is a debit to the seller on the CD. The seller also pays excise tax. To calculate excise tax, we take 5/100 of the purchase price. So just take your purchase price, divide by 500. The seller pays that tax. They tax you when you buy it. They tax you while you own it. And they got one more chance to tax it when you sell it, and that's called excise tax. So it's their last opportunity to get you. Other seller debits, they got to pay off all their existing loans and liens. They're going to pay off any delinquent real property taxes. So if the seller never paid 2024 taxes, they're going to be responsible for those at settlement. And then the seller will also pay any personal property taxes, those both delinquent and current. Then we look at the buyer's debits. Unless you're told otherwise, the buyer's going to pay for everything that they're doing during due diligence. So we talked about the home inspection, the pest inspection, the survey, the radon test. All those inspections will show up as a debit to the buyer, unless we're told otherwise. They have to pay for the first year of homeowners insurance. Homeowners insurance is paid in advance. So if I were to pay my homeowners insurance policy today, I would be covered until December 31st, 2026. So at closing, because the buyer's homeowners insurance is originating today, then they're going to go ahead and pay for that first year at closing. So they're covered for that first year. Let's see, the buyer's responsible anything to do with the loan because it's their loan. So origination fees, discount points, interim interest, private mortgage insurance, anything related to the buyer's new loan will be a debit to the buyer. The buyer's going to pay to have the deed and the lender's deed of trust recorded. So the attorney has to charge that recording fee. The buyer gets to pay for it. I do want to point something out that tends to be, can cause confusion. So I want to make sure that we see it. The seller pays to have the deed prepared. The buyer pays to have the deed recorded. Now, I always remember it this way. When the attorney is getting the deed ready for closing, it's still the seller's deed. So they get to pay to have it prepared. It's in the buyer's best interest to have that thing recorded. So they will pay the deed recording fee. Okay, how you
Yeah,
doing over there?
I was getting ready to ask to say that again. You said the buyer pays to record the deed and the seller pays to have it prepared.
That's it. That's it. So there's the attorney fee that the buyer's going to pay. That's part of their cost down here. The buyer hires the attorney, so they're going to pay the attorney. In addition to that, the attorney charges a separate fee to prepare the deed, to get it ready for closing or settlement, and that's what the seller gets to pay for. The seller is always welcome to have their own representation as well. So it might be that they have their own attorney drafting up a deed, preparing the deed, I should say, and then they're sending it to the closing attorney. So we're good. We see the difference in preparation versus recording. Other things that the buyer gets to pay for: title insurance. If a lender's involved, there's two policies, one for the owner and one for the lender. Title insurance kicks in when the buyer becomes the owner. So as soon as that deed is recorded, title insurance starts. The buyer's got to pay for it at settlement, though. So when we say owner's policy, we're referring to the future owner. The buyer is paying for their policy when they become the owner. Title insurance only has to be paid one time. It's a one and done. The buyer gets to pay for both. They'll pay for their policy and they'll pay for the lender's policy. Yes, ma'am.
When is the best interest for the seller to pay for their own attorney to prepare the deed?
I say for the most part, sellers will let the buyer's closing attorney handle anything. But if it's an estate, estates can get really messy. So the seller, the heirs might come with an attorney already. Maybe they had a trustee that was managing, you know what I'm saying? So if it's an estate, you might have the seller represent themselves. If it's a commercial transaction, both parties are more than likely represented. So I'd say for the most part, the seller is fine. The residential seller is fine with letting the buyer's attorney. But just always remember, if the seller looks at you and says, "Can I have my own representation?" Absolutely. You're always welcome to have your own. The attorneys just need to, cahoot. They need to work together.
That's good to know. Thank you.
I mean, what if my brother-in-law was an attorney? I'd rather him handle my stuff than that. You know what I'm saying? So there could be reasons why, but I'd say for the most part, seller's going to let the buyer's attorney do it unless they have, let's call it even extenuating circumstance, but a different kind of situation.
Okay. Thank you. Yeah, my dad left some property in a trust in an estate, and so we're in that same situation now. Should we have our attorney?
And you have your attorney that's helping you guys, because it just,
Yes,
I mean, I don't know. We had a closing last week and there were heirs. I think there were like 10 people that had to sign that closing disclosure. I mean, it was just because of all the heirs. And of course, all the heirs, if they're married, now we got to get all their spouses. I mean, and I'm like, y'all can't fit another signature on this. We would if we had to. But the more people you have involved, the messier it can get. So title insurance, again, one and done charge at settlement. If the buyer had a survey done, there's our closing attorney fees, and then any of those advanced escrow deposits we mentioned. We know the lender is going to have an escrow account for the buyer so they can pay taxes and insurance on their behalf. But they also need to collect some money up front to fund the account. Also, under the buyer debits, for our purposes, these are going to be considered distractions. Things that are POC or paid outside of closing, it means that they've already been paid and we don't want to charge the buyer for it again. So on our CD, we called it borrower paid before closing. Here we call it paid outside of closing. So the appraisal and the credit report, you can put on the CD if you want to, but these aren't the calculations that we would need to do because they've already been paid. And what we're trying to do is figure out how much does your buyer have to bring to closing. There's some credits for both parties. So some buyer credits, earnest money will always be a credit to the buyer. We told our buyers when we went under contract, you put this earnest money deposit and it will be credited back to you at closing. So the earnest money deposit will always be a credit to the buyer at closing. And the other big credit to the buyer is going to be the loan amount. The lender is bringing them this money today on their behalf. So today, on the day of settlement, the loan amount is a credit to the buyer, and the buyer will spend the next 30 years paying the lender back. Think of this CD, think of the settlement statement as kind of a snapshot of what's going on today. And today, the lender's showing up with those funds. Since this is a who pays for what cheat sheet, I've included the prorated things that we've talked about. So you have this on the same page. You have this in one nice, neat little packet. So it tells us if the taxes have been paid versus not paid, HOA dues, rent, etc. And then we have double entry items. And double entry items mean they're going to show up twice on the settlement statement. So in addition to the prorated, the sales price and the due diligence fee are going to be double entry items. The sales price will show up as a credit to the seller, debit to the buyer. That's the money that the buyer owes the seller to purchase the property. Just like we credited the buyer the earnest money deposit, we're also going to credit the buyer the due diligence fee. Because the seller touches the due diligence fee, we're going to debit the seller, credit the buyer. So both due diligence and earnest money are a credit to the buyer at closing. Thoughts? Comments? So like we said, this can be found later this evening. I'll send you that Google Drive. So for class tomorrow, if you can print tonight, it'd be helpful. If not, bring a blank piece of paper and we'll make it work. But for class tomorrow, if you guys could bring a blank CD, and if you want to pull up or have this who pays for what at closing in front of you, I think it'd be helpful as we go through it. The first few times you go through it, because like we said, it's a lot of information. So the first few times we go through it, it's going to be like a little but I tell you, when you go through it a second time, third time, it's going to get a little bit better and a little bit better. So that's where we're starting tomorrow morning. I don't want to get too far into that today because I think we've already done enough math for the day. And I think as long as Jessica will have coffee in the morning, I think we'll be fresher. She's in, cool. So I think we'll be fresher. And better prepared to do that CD. So that's my agenda for tomorrow. We're going to spend most of tomorrow morning working through the closing disclosure. I also have, I can't make it mandatory because it's not in the policy and procedure, but what I can do it is call it a highly recommended homework assignment. So we'll talk about what that is, and I give that to you as a homework assignment so you can look at it over the week, work through it for the week, and then we will use that next weekend for our review to help us get ready for the exam. So we'll actually get to do 2 CDs together. We'll get to go through this twice, one tomorrow and then again next weekend before your test. And that's the whole purpose for me rearranging this class. So we have time in between to let it marinate, to let it all sink in. So questions or comments, concerns? We're good? Okay. With that being said, we're going to put the CD stuff down aside for now. We are going to start looking at the contract piece of it because that's where we are the rest of the class is the contract piece of it. And that's what we're gonna do the rest of our time together. I hate to start a math problem and then not be able to finish. And I'm watching our time and I just want to make sure we have enough time. So I've just kind of made the executive decision to push that to tomorrow morning. The other thing before we jump into contract piece of it, I just want to point out the North Carolina Real Estate Commission's website. I know you guys have been here because you had to come here to submit your application. But I just want to point out that the website is a plethora of information. The Real Estate Commission's main purpose is to protect the public. And one way they can protect the public is by educating the public. So the Real Estate Commission's website is jam-packed full of information for the public. And the commission says, hey, if you find something on our site, you're welcome to use it when you're talking to the public. So I encourage you guys, as you're looking for resources, as you're looking for tools, consider the Real Estate Commission's website. You don't have to recreate the wheel. The wheel has already been created. And the tabs in specific that I like, publications, resources, that's all good. But in particular, what I find the most helpful, and I sound a little redundant here, but if you go publications, when you're taken to this publications tab, it's going to give you, here's the commission's guides. Here's our safety guide. Here's our square footage guide. There's a whole bunch of Q&A brochures, you guys. If you have a buyer that doesn't understand the due diligence process, the Real Estate Commission has a publication for that. If we're not understanding the difference in condos and townhomes, for example, the Real Estate Commission has sources here for us to use to help when we're working with the public. So spend some time on the commission's website, learn these various things, these resources. When I used to do a lot of new agent training. Like I got you guys right when you got licensed. And I'm going to be honest, probably the number one concern I hear from new agents is, I don't know what to say. Like I have all this information from pre-licensing and now I'm looking at a buyer and seller and I'm supposed to say what? And my answer is always to be familiar with the forms. Let the forms and the Q&A guides and the brochures help you put words in your mouth. You don't have to create the wheels. The wheels have already been created. So add the commission's website to your tool belt. Great place, great source for information. I'm going to go back to the home page. You guys may or may not know, now that you're licensed, you have a licensee login. If you haven't accessed your licensee login page yet, go ahead and do so. This is where you're going to renew your license every year. If you move or change your address, you're going to update your information here. This is also where you guys can make sure that your post licensing and your CE classes have posted. So once you finish a post class, once you finish a CE class, give it about a week. It's not going to happen immediately, but give it about a week. Log into your licensee account and make sure you got credit for that post licensing. Make sure you got credit for that CE class. And if it hasn't posted in a week or so, you contact the director. So in our case, you would call Lane. Do not call the real estate commission. Call Lane. There's several hands that have to touch it. So the source, it starts with Lane or the director of whatever school you take CE or post licensing with. So Bryson, I know this is your first one. Kay, I know you've taken one, and Jessica, this is your third. So if you guys haven't made sure that your Kay and Jessica, if you haven't made sure that your other post licensing classes have posted yet, I do recommend doing that, because I'd hate for you guys to get to day 181 and find out it didn't post for some reason. You know what I'm saying? I'd hate for you to get after July 10th and find out your CE. So always verify, always check your records in that licensee login. Did you guys get the bulletin yesterday from the real estate commission? They emailed the bulletin. Have you signed up for that yet? If not, you can do that. Where is it? They send the bulletin out. Here it is under publications. Subscribe to e-bulletin, and it comes out the last day of every month. So if you didn't get that last night, you can see here's October's 2025 e-bulletin on the homepage, so you're not missing anything. But you definitely want to, under publications, make sure you subscribe to the e-bulletin so you can get that every month. It's about the only way the commission can communicate with all of us across the state. So they send us this monthly publication. You guys have heard about the disciplinary actions. You can read all about the disciplinary actions in the e-bulletin. And the last thing here I want to point out, you know, in pre-licensing and post-licensing, we give you fish. Eventually, you need to learn how to get your own fish and knowing your tools, knowing your resources. And on the home page right here is a link straight to license law and commission rule. So we've been given this to you, but now you guys may need to find this on your own, and the current will always be here. So if you need a specific law, if you need a specific rule, please don't go to Google. Google gets outdated fast. Come to ncrec.gov and make sure you're always following the current license law and the current commission rule. And you guys can even, I'm subscribed to this, and it's pretty interesting. You can subscribe to a mailing list that they'll send you proposed rule changes. So if they're thinking about changing a rule, you could be one of the first ones to know. So you can use, you know, as much or little as you want, but the information is here. There's a plethora of it here. So I just like to introduce you to ncrec.gov. It's not just about filling out your application to go take your state exam. There's so much more here. And I hope that you will take advantage of the free resources that you guys already have, of the tools that are available to you guys as you're sorting through this new career of yours. Any questions or comments just in general? And look at this, always trips me out. Consumers can file a complaint right there. They make it really big and easy, don't they? It's really easy to file a complaint right smack dab on the homepage. Thanks, guys. All right, guys, let's go ahead and take our last break. 3:50. We'll come back. Let's round it up. Just say 4 o'clock. And at 4 o'clock, we're going to talk a little bit about the contract piece of it. So we're going to go back in time and form the contract. So let's take 10 first, though. Welcome back. So now that we've gone to closing, let's go back and put this thing under contract. And that's going to take us back to chapters 10 and 11 in your real estate manual. 10, we're going to get through pretty quickly because 10 is just some basic contract law. I don't care where you are. I don't care what kind of contract you're dealing with. Basic contract law says that this applies. You and I, we know we're not attorneys. We know we can't give legal advice. However, you and I deal on a regular basis, specifically with the sales contract. So we need to know the ins and outs of these things. We need to know how they work. And that's what 10 is about. 11, we're going to get into our standard offer to purchase and contract. We're going to look at the one that we use the most. And we're going to do a very thorough review of the offer to purchase and contract form 2T. So once we're done with closing, that's kind of where we are the rest of the time. We're going to kind of review the basics, talk about the basics. Again, I know this says real estate contract, and this does apply to real estate contracts, but this applies to all contracts. So the number one question is, well, Julie, what the heck is a contract? And a contract is a legal agreement between competent parties for a legal act. A contract is a legal agreement. Understand the enormity of what we're saying here, you guys. You and I are responsible for legally binding buyers and sellers. We're not over here playing house. We are officially putting them under contract. And an error on my part could cost them money because we're preparing it for them. We're preparing it on behalf of them. So understand coming into this that we are responsible for creating legally binding agreements between the two parties. So it's important that we're familiar with the contract. It's important that we review the provisions with our parties. I'm going to be very honest with you guys. This might blow your mind. I doubt it will. Buyers and sellers do not sit down and read the contract. They do not. Shocking, isn't it? Because they trust their agent. I bought a house before I became an agent. Do y'all think I read the contract? No. Do you think I read agency agreements? No. Y'all, it blows my mind. That's why it's so important that you and I understand. And we still need to always take the time to explain these provisions, explain the terms to our parties. The other big piece to know about a contract is it's for a legal act. You can't have a legally binding contract for an illegal purpose. Makes sense, right? So if you have an illegal purpose, then the contract isn't going to stand up in a court of law. In real estate, what could make a contract illegal, for example, could be a discriminatory act. If they're seen as a discriminatory act in the contract, then it could be proven that we do not have a legally binding agreement. So fair housing absolutely applies. Other things we need to look out for, like fraud, forgery, stuff like that. So, Kay, I know you asked a great question earlier about that pre-approval, that pre-qualification letter for your buyers. You know, when you first meet with buyers and sellers, take the time to verify their identity. Especially right now, there's a lot of seller scams out there. North Carolina Realtors Association says, if you get a call from an absentee seller or from a seller in a different state that has vacant land to sell, assume that it's a scam until you can prove it otherwise. So there's a lot going on out there right now, you guys, and I always need you to protect yourself. And one way you can do that is verify the identity of the people you're talking to. Kay has something good to say about that. Yeah.
Yes, because I'm sure you've heard a lot. What I don't understand. I've seen commercials too, where people have had their homes stolen, the deed change. And I'm asking myself, how in the world that can happen?
Forgery.
So
Forgery.
take it
So
to,
somebody else is signing your deed over. They're signing your name.
and and then nobody, the person, I don't in the transaction, who, I
So
don't
in the meantime, now that the property has changed hands, now they can take out a line of credit, they can take out an equity line, and you're living there. You have no idea that the deed's no longer yours until they start foreclosing on you. You know what I'm saying? So it's the scammers, the hackers, they're good at what they do. And so, Kay, to your point, I mean, I don't know if you guys are homeowners. We know Jessica is. I don't know about if you guys, but if you guys are homeowners, I mean, it's suggested you check in on your deed every once in a while, make sure that there's no, in the public record search, and make sure that there's no fraudulent activity on your deed. I'm not going to lie. I don't understand how the scammers work, and I don't always understand their end game, which I guess is why I'm here and not out there being a hacker or a scammer. You know what I'm saying? But it's all about getting information and hopefully eventually getting money. And if they can make money off of you, then that's what they're trying to do with these deed and title schemes.
I wonder putting it in a trust as a layer of protection.
It could absolutely, but there's still one recorded deed that could be forged.
That's great. That's wow, how that's
It,
done. And it seemed like the person who is giving the loan have some type of responsibility to verify the
oh,
ownership.
they're all in it together. It's a
Oh,
conglomeration. And Kay, you and I, because we're good, honest, decent people, and we just have a hard time wrapping our brains around, you
yeah.
know, the hows, the whys, but what I do know is it's happening. So
Yeah.
taking those extra steps always to protect yourself, not just in real estate, you guys, but always taking those extra steps to protect yourself. When you meet a buyer or seller for the first time, it's okay to ask them for their ID, their photo ID. We know I need their full legal names eventually anyway. So why not ask for it up front? If you're getting ready to list it, you want to make sure the people that you're talking to are the ones that can sell it. If they're buying it, we want to make sure we know who those people are as well. So maybe that's part of your new people checklist. And remember, fair housing, what we do for one, we do for all. So if you ask one buyer for a photo ID, in all fairness, we need to ask them all. Seller, and again, all that's just taking steps for us. We got to do our due diligence these days. And the hackers and the scammers, while you and I are still trying to figure this one out, they're already forming the next one. You know what I'm saying? They're always a step or five ahead of us. So we always just got to make sure that we're protecting ourselves and, when necessary, protecting our clients as well. There's some mean people in this world. I don't like mean people. you know? So the basic gist of the contract, again, we're creating this legally binding document for buyers and sellers, and understanding the enormity of what we're doing here. One thing that may come up, may not come up, but one thing that may come up is the question of the validity of a contract. In other words, is this a valid contract? And when we're determining the validity of a contract, or specifically if the judge is asked to determine the validity of a contract, the judge is going to look for some key essential elements. And these essential elements, if present, will allow the judge to say, hey, this is a valid contract. So if you ever hand any kind of contract to the judge and say, is this valid? The judge is looking for some ingredients. Specifically, the judge is looking for mutual assent, also known as meeting of the minds, also known as offer and acceptance. We need to show that the parties came together and agreed to enter into the contract together. So an offer is made, it's considered, maybe it's countered a few times, and eventually accepted. That shows our mutual assent. That shows that the parties agreed to enter into the contract together. You guys remind me what we're documenting? Jessica's trying to frantically unmute. I see it. Everything. So make sure,
Sorry.
make sure when you and I are negotiating with the other agent, we're speaking on behalf of our parties as we're working this back and forth. The communication I have with my client, the communication I have with the other agent, it all shows that mutual assent. It shows that we came together and we agreed to enter into this contract together. So the judge will look for mutual assent. The judge is going to look for some form of consideration. Now, typically speaking, when we think of consideration, we think of money. In our sales contract, the consideration would be the purchase price. The buyer agrees to pay X amount in exchange for the property. In basic contract world, consideration isn't necessarily money. It's anything of value. So if you can put a price tag on it, we have to have some form of consideration. And by the way, if you're gifting a property, maybe you're giving a gift to a kid or you're getting a gift from your parents, the consideration would typically be for love and affection. There's some form, something of value to make this a valid contract. We got to have legal capacity of the parties. The parties need to be of their sound, sober mind. They need to be of age. If not, there might be an out for them. And I will talk about that in just a minute. Remember, I can't stop a minor from buying or entering into a contract. I can't stop a minor from signing a document and saying we're under contract. But the minor can't be forced to carry through with those terms because they're not an adult yet. So if we learn later that we don't have legal capacity, then it might be an out for the parties. More on that in just a second. The other thing the judge would be looking for is lawful objective. Again, you cannot have a legally binding contract for an illegal purpose. It's not going to stand up in a court of law. So we mentioned discriminatory practices, fraud, forgery, things like that. So if the question of the validity of the contract ever pops up, these things are what the judge is looking for. One of the many benefits of using the pre-printed forms that we have available to us is that we know we're going to have things like consideration and lawful objective. We know that our pre-printed forms have been drafted by an attorney. We know that we're off to a good start with meeting these essential elements of a contract.
What if the person is what if the person is an older person that becomes, what do you call it? That's dementia, starts suffering from dementia, or
If you start having concerns about the client's capacity, let's say you're talking with this seller and one spouse says to another, more so than normal, did you understand that? Are you with us? Do you know what we're talking about? You know what I'm saying? If you start having signs that make you question, then we almost kind of need to stop and we need to make sure that the people we're talking to have that capacity. So we may have to ask some questions. We may need to get with our BIC. I mean, I wouldn't blatantly flat out ask somebody, but we can identify signs. And if you ever have concerns about the capacity of a client, then we may need to bring in another opinion, may that be medical or law, whatever. I'll share with you guys, I had a buyer once. She kind of fell in my, not kind of, she fell into my lap, literally. That doesn't happen often. So when you do, rejoice. So this lady fell into my lap, and this woman was Vietnamese, and English was not her first language. Now, she spoke really well English, but it wasn't her first language. And especially getting into terms of the contract, we were having a hard time. And I said, do you have somebody that can help us translate, help us interpret? And she said, well, my son. So the son was able to come in and sit with us and make sure, as I was explaining, like due diligence fee, that she was better able to understand that. So anytime a concern, and that's a great concern, Kay, because anytime we have concerns, what I'm going to suggest to you is stop and do more due diligence. Sometimes we have to ask the hard questions. Sometimes we need to ask for, like I said, medical records, or whatever the situation may be. But I can't just bear down and hunker down and just persevere going forward if I got those signs and those red flags going on all around me. Another good thing, if you're helping buyers buy, let's say you meet the buyer and the buyer shares with you that they're married, but you never meet the spouse. My flag's going up, right? Like, you're telling me somebody else has to be a part of this, but I can't get them. Same thing when we're going to sell. If we can't meet the spouses or get the spouses to sign, whether they're on the deed or not, North Carolina is a spousal state, 1 to buy, 2 to sell. So looking for these signs, always identifying those red flags. At least we can get some questions answered. And when in doubt, y'all, you got a BIC. This is why you have a BIC. So when in doubt, don't hesitate to talk to your BIC about how to best proceed in this situation. So contracts, the formation of contracts, it all starts with an offer. An offer is made to one party and an offer is considered. Whenever somebody receives an offer, they always have 3 choices. You can accept the offer. If you accept the offer, you're agreeing to all of the terms exactly how they are. Any change, and we do not have full acceptance. The party receiving the offer could reject the offer. The rejection is a flat out no. The offer is dead on the table. And once an offer has been rejected, there is no reviving it. Once it's been rejected, it is dead on the table. You can't go back. The third option then is to counter. A counter offer is a rejection. It's a rejection with a but, or a rejection with a however. I'm good with all the terms, but the purchase price and the closing date, for example. So hopefully with a counter offer, you got sellers up here, you got buyers here, and hopefully each counter gets us a little bit closer and a little bit closer together. So when an offer's made, the parties have options. You can accept the offer, you can reject the offer, if you can counter the offer. More on that. Assuming that we have acceptance, then we're a step closer to forming our contract. Contracts are formed. I need a few things, and acceptance is one of them. Let me just go ahead and say here, if you guys get verbal acceptance, if you've got verbal acceptance, you've got nothing. When I say acceptance, we need to know that it has been signed. Can we hear the difference in, oh yeah, this is good, I accept the terms, I'll sign it as soon as I get home. The intent is there, but can a lot happen between now and the time they get home? So they may intend to sign it, they may have every intention, but until I have a signature, we do not have acceptance. And once we do have that signature, once we do have that acceptance, then that acceptance needs to be communicated to the party that makes the offer. You've got to let the person that makes the offer know that their offer has been accepted. And that's what we're communicating, is communication of acceptance. And once we have that acceptance and that communication of acceptance, then and only then are we under contract. So as you guys have already learned about me just a few minutes ago, I'm a visual person. So let's draw a picture. And let's talk about this contract formation and how this looks. So you have the contract formation wall, and on one side of the wall, I got the buyer's agent, I got the buyer, and we're going to say that the buyer is the one making the offer. So the buyer is going to be the offeror or the giver of the offer. On the other side of the contract formation wall, we have the listing agent, the seller, and they're going to be the offeree or the receivee of the offer. So in basic contract verbiage, I got the giver of the offer and the receivee of the offer. The majority of the time in real estate, the buyer's making the offer to the seller. But don't get stuck in your own way. There are certainly times that the seller can make an offer to sell to the buyer. So either party could give the offer. It just so happens that we see the buyer making the offer to the seller, as is our example here. So you are a buyer's agent. You are out showing property, Jessica. This is going to happen to you soon. One day soon, your buyer's going to walk in the front door and they're going to go, oh my God, this is the one. This is the one I've been looking for. And so Jessica's going to silently do her happy dance because, so you look at your buyers and you say, awesome, we're going to write it up. So you sit down, you talk to them if you haven't already about due diligence and earnest money and all those things we'll talk about when we look at our contract. You're going to fill in the blanks of the contract or the offer, I should say, on behalf of your buyer. And once you filled in all those blanks, you're going to have your buyer sign the offer. We got to show that this is the buyer's offer. We have to have the buyer sign it. The seller needs to know that this is legit. So then Jessica is our buyer's agent. I just kind of gave you a role. So here you go. Jessica as our buyer's agent. Kay, you want to be my listing agent? I'll get you in a minute, Bryson, I promise. So Kay is going to be my listing agent. Jessica is my selling agent, my buyer's agent. So Jessica calls Kay and says, I'm presenting an offer on behalf of my buyer. And anything that she needs Kay to know, she will let Kay know. And Kay always says, thank you for your offer. Because I still think please and thank you go a long ways today. They didn't have to bring you the offer. So we say, thank you for your offer. I will discuss it with my sellers and get back in touch. So Kay calls her sellers and Kay says, we have an offer. And the sellers go, woohoo, everybody's celebrating now, right? So Kay goes over the terms of the offer with her sellers, and the sellers say, Agent Kay, what are my choices? And Kay says, seller, you can accept it, you can reject it, or you can counter it. If you accept, you're agreeing to all of the terms. If you reject, you've killed it. It is dead on the table. If you counter it, the roles have reversed. A counter offer is a rejection. And with a counter offer, the offeree becomes the offeror becomes the offeree. Now I have the seller making a brand new offer to the buyer. And again, it's going to sound something like, my guys are good with everything but the purchase price and the closing date. This is what we counter. This is what we propose. So Kay is communicating with Jessica. Kay tells Jessica that her sellers have countered, and here are the terms that they want to counter. Jessica says, thank you for your counter. I will talk to my buyers and be back in touch. Jessica calls her buyers and says, my guys have countered. And her buyers are going to say, what are my choices? All offerees have three choices. They can accept it, they can reject it, or they can counter it. I'm going to say that again because it's super important. All offerees have three choices: accept it, reject it, or counter it.
I have a question.
Yeah.
Let's say, for example, the seller posts in the post online that they want to sell the house as is.
Mm-hmm.
However, when the offer comes in, they're asking for XYZ. At that point, as a seller, we can automatically reject. We
They
can
got three choices.
the
They can
same
accept
control
it,
still apply.
they can reject it, or they can't. So they said, no, I said as is and I mean it. I'm not fixing anything. Maybe that's the counter. I'm good with all the terms except for XYZ that you want fixed. Or maybe the seller says, no, I just don't want to deal with it. So I'm going to reject. You always have three choices when an offer comes in.
Accept, reject, or counter offer.
She's got it. Yep.
That
So the
makes
seller says, do I have, think about the low ball offer that's just going to make the seller mad. Think about this. We know it's going to just tick them off. It's almost insulting, but through the eyes of the buyers, you don't know what they're going to say. Sometimes you got to shoot your shot. So they present this low ball offer. The seller's got three choices. They can accept it, they can reject it, or they can counter it. They always have three choices. And remember, you guys, this is a great point for me to remind you of a commission rule that says I have a duty to present all offers, even the low ball offer that's just going to make the seller mad. We got to present all offers, let them decide if they want to accept, reject, or counter.
I have another question. When the right to inspect the property.
Once we're under contract,
Okay.
unless we can work it out otherwise. You can always call and ask, but caution about having your buyer do inspections before we're under contract. We want to get them under contract first. That's part of that due diligence.
And then they have so many days to either walk away.
Whatever our due diligence period is. And that's all negotiable. Is it 2 days? Is it 20? That's all negotiable. Yep. So back to our scenario here. Jessica Kay's given Jessica a counter. Jessica's called her buyers and said they're good with everything but the purchase price and the closing date. The buyer says, okay, Jessica, what are my choices? She said, you can accept, reject, or counter. Oops. Let's just pretend for simplicity here that the buyer chooses to accept the seller's counteroffer. That means I got to have the buyer's signature on the counteroffer. Because remember, you guys, if you got verbal acceptance, you have absolutely nothing. You may have been taught in pre-licensing that acceptance is a signature, but we're in the real world now. And in the real world, when the other agent calls you and says, my guys have accepted, I need your knee-jerk reaction to be to ask, has it been signed? So Jessica has her guys sign. I have acceptance. And then the next piece is communication of acceptance. And this is where the line comes into play. In order to have a legally binding contract, I need communication of acceptance to cross the line. I got to let the offeror know that their offer's been accepted. So the buyer calls Jessica and says, my guys have signed. We're still all on the same side of the wall. Communication has not crossed the line yet. Jessica calls Kay and says, my guys have signed. Did communication just cross the line? The communication crossed the line?
Mm-hmm.
Yeah, congratulations, folks. When Jessica calls Kay, that communication crosses the line. Congratulations, we are under contract. Kay, what's the next thing you're going to do?
As a seller,
No, as the listing agent.
put it on going to the system, MLS.
You'll get there. You'll get there. What's the next thing you need to do?
Oh,
We need to let our seller know.
No, no. Oh, okay.
You
Yeah.
gotta let the seller know the good news. You
Yes,
know,
yes,
you
yes. That's
know,
it. I'm jumping
which is
ahead.
awesome. Kay's ready to put this thing DDP and MLS, and I hear you. But but what we're getting at here, and thank you for letting me put you on the spot. I didn't, but thank you.
Okay.
What we're getting at here, you guys, is that communication across the line between the agents, communicating to me is just as good as communicating to my client. So once you tell me it's been accepted or terminated, anything like that, communication to me is just as good as communicating to my client. And in Kay, in this point, Jessica's called you. So now the very next thing you need to do is call your sellers and tell them the good news. Understand what we're saying here with that communication crossing the line. What I'm communicating is acceptance. I'm communicating the fact that it has been signed. Maybe when Jessica called Kay, she was out and about, she was doing things, she knew her guys had signed it, but she's not at a place right now to deliver the signed contract. She will later when she gets home, but what she's doing right now is communicating acceptance. She's letting Kay know that her guys have signed. And Jessica will tell Kay, as soon as I get back to my device later this afternoon, I will send you the signed contract. It's the difference in communicating the fact that it's been signed versus delivering the instrument. We're going to talk about the different methods for communicating acceptance. I'll go ahead and say it's whatever the parties agree to. So if we agree to communicate via email or text message, whatever, carrier pigeon, whatever the parties agree to. And again, what we're communicating is the fact that it has been signed. Those two pieces, acceptance and communication of acceptance, are required for contract formation. So we'll walk through our contract formation wall again. Again, I think it's a good visual to help us see that magic moment in time when that communication of acceptance crosses the line, that communication wall. So let's run through a scenario. Jessica, was that a question or just a, no? Okay. All right. I saw movement. So like, all right, let's see. Let's run through a scenario, probably a real world scenario, because this stuff comes up a lot. And let me just say, you guys, please don't tell your buyers and sellers they're under contract until they are. Again, I'll sign when I get home is not the same thing as I have signed. So I need you to obviously keep buyers and sellers, communicate with them, let them know where we are in the process. But please don't ever look at them and tell them they're under contract until they are. So let's run through a scenario here. Buyer and seller's agent verbally negotiate. So we're going back and forth via text message or something. You know, maybe we're not on the actual offer to purchase and contract yet. We're just verbally negotiating, going back and forth between the agents. The agents are communicating with their clients. We finally agree on the terms. The buyer signs the offer, which means I have acceptance. Is that all I need? Acceptance? No, it's one of the steps, but I also need communication of acceptance. So the buyer signs, that's step one. We're not under contract yet. Everybody with me? Because we haven't communicated that yet. But the agent gets ahead of themselves, thinking that this is going to happen. And so they tell their client, hey, guess what? We're under contract. Congratulations. They've never communicated this fact. The buyer has come in from another state to look at properties. You tell them they go under contract and they hop on a plane to go back home. So they're in the air somewhere thinking they are under contract. Do we see where we're going with this? In the meantime, before that communication of acceptance happens, I have a signature, but we've never communicated it to the other side. And in the meantime, guess what? A better offer swoops in. And we try to reach out to the buyer to let the buyer know. But guess what? They can't respond because they're on a plane. There it is, because they're on a plane. Another offer comes in, they agree, they negotiate, and guess what? Your buyer loses their dream home because you didn't communicate acceptance. Communicating acceptance, guys, I need you, once you know your buyer has signed, for example, your party has signed that acceptance, I need you to stop what you're doing and make sure you communicate that acceptance. And I don't know, guys, it's almost 2026. How long does it take you to send a text that says, my guys have accepted, I will send you the signed contract ASAP? How long did that take you to do? You guys with me? So pull over on the side of the road or stop what you're doing, send that text. You can send the signed contract later. What I need you to do right now is communicate the fact that your buyers have signed. Because so many times it happens that a better offer comes swooping in. Obviously, the seller's going to do what's best for them. And if a better offer comes in, yes, they're going to accept it if they don't know your buyer hasn't signed. I don't know about you guys, but so many times your buyer calls you and says, okay, I've signed. And I say, okay, well, I'm out and about running errands and I got to go to the grocery store. And as soon as I get home, and we know what it's like when we get home, because you got kids and pets and spouses that need stuff. And so you get busy and it gets away from you. You don't do it. And then in the meantime, another offer comes in. Y'all, I'd have a hard time putting my head down tonight, going to sleep, knowing that I cost my buyer their dream home because I couldn't send a text, because I couldn't pick up the phone and call. You guys with me? So communication is really important anyway, but especially when we're negotiating that offer, especially when we have that acceptance. Communicate acceptance. I will get you the signed contract later. I did an open house several years ago. It's been quite a few years now. And I remember the couple came in and I don't know, they were just really quiet, which is fine. I know people are reserved. They're hesitant to say much around the agent. So they came in and kind of toured the house and they got done. And I said, you guys have any questions? And they were like, nah. They said, we're a little defeated. To be honest, we were under contract to buy a house, but the seller backed out. And I said, oh, I'm sorry to hear that, because I know that's tough. And I said, I'm sorry to hear that. And they said, yeah, the seller said that they were going to accept it, but before they could sign, another offer, a better offer came in. And these guys genuinely felt like they lost their deal. Had that communication of acceptance happen, of course, I don't know the specifics because it wasn't my transaction, but had that communication of acceptance happen, then that other offer couldn't come in. It couldn't swoop them off. So make sure that we're not only communicating, but the key word here is that we're promptly communicating. And when it comes to offers, termination, acceptance of offers, etc., communicating to the agent is just as good as communicating to the party. So that's why when Jessica told Kay that her guys had signed, communication of acceptance crossed the line, and we were under contract, even though Kay hadn't told her sellers yet. Communicating to the agent is just as good when it comes to accepting an offer, is just as good as communicating to that party. Please be prompt. Please be responsive. You guys, at some point in your real estate career, are going to want to take a vacation. And I think you should. I think everybody deserves a vacation, a true vacation, which means you don't have to have your laptop with you on the beach. If you have backup, if you have coverage. Real estate doesn't slow down for me to go to the beach. Buyers are going to buy, sellers are going to sell, whether I want to take a vacation or not. So when you're ready to go on vacation, especially if you're in the throes of a transaction, have your BIC or somebody be prepared to fill in for you. Remember, the agency agreements is between the client and the firm. So anybody on behalf of the firm can step in and assist. If you don't have coverage, then have you guys ever seen that person on the beach with their laptop out? That could be you. You don't want to be that person. Laptops don't belong on the beach. I'm sorry. They do not. So have that backup. Maybe you team up with somebody. Hey, I'll cover you on your vacation if you cover me on mine. We can work together. But just remember, you guys, real estate does not slow down because you're not available at this time, at this moment. Does that make sense? And there's an old saying in this industry. Says if you want to sell a house, just go on vacation. It works tried and true every single time. I swear, about the time you're pulling your suitcase out the closet, your phone is going to start blowing up. And you're going, but I just want to go to the beach. Have backup, have coverage.
In situations like that, do you have to pay someone to help you with that?
That's for something for you guys to work out. Like I said, maybe if I cover your vacation, you can help me with mine. Maybe I got a lot going on, so I may offer you something, but that's something between the agents and possibly the BIC, whatever the firm's policy are on that. For me personally, unless you're asking me to do too much, I'm happy to help out. But I also know who I'm calling when I need help too. So I like you scratch my back, I'll scratch yours. Definitely works out. But again, it's whatever you guys work out. Okay, there's no standard there.
Okay.
The other thing to take into consideration when we're forming these contracts is your role. What role are you playing in the transaction? Are you a listing agent? Are you a selling agent? Are you a dual agent? Are you a designated dual agent? Are you a seller sub agent? So understanding your role, specifically what hat you're wearing, enables me to determine how to negotiate. Remember, as a dual agent, advocacy goes away. So when my sellers say, should I counter? Should I do this? I got to protect both sides, because dual agency is about the firm. And I can't say anything to my seller that's going to harm my firm's buyer, and vice versa. So knowing your role, knowing what hat you're wearing in the transaction is so important to know how you can proceed, what kind of advice, what kind of information you can give. If you're working as a seller sub-agent, you're working with an unrepresented buyer, which means everything you do, your best interest is for the seller. So when the buyer looks at you and says, how much should I offer? Don't think about it. Just say, offer the asking price, or more, because that's what's in the best interest of the seller. We got to know those roles. We got to know those hats that we're wearing, especially when we're negotiating. You're going to, let's see, Jessica has maybe Kay. Bryson, you got 301. 301 is brokerage relationships and responsibilities, which is just a fancy way of saying agency. So you're going to get a good in-depth on the different roles, dual agency, that kind of thing. Kay, I'm not sure what the other one you have done. Have you done 301 or 303? You've done one? Okay, so you still have three. So you've been through the agency thing, but that's a good class. That brokerage relationship and responsibility is a good way to help us identify our roles. And guys, I don't know. Life gets so complicated sometimes. It gets so messy. And I try really hard to operate by super simple philosophies, because if I can keep it simple, then I'm better. And one of my super simple philosophies, when in doubt, find out. The resources are there, the tools are there. Don't say, well, I don't know. When in doubt, find out. You have these resources. Get with your BIC. Your BIC should be up there in your number one resources. So we talked about acceptance, communication of acceptance, and as mentioned, that's not the only response that the offeree can give. Acceptance is one of the options. Another option is they could just flat out say no. They can reject the offer. If your seller wants to reject, if it's a decent offer and your seller wants to reject, this could open the communication door for why aren't you at least countering this offer? You know, this is a decent offer. It's not quite what you want, but maybe a counter, we can get it for you. Even in a low ball offer, you guys, I encourage my sellers to counter. We get a low ball offer, I'm like, let's counter up to our terms, because we're going to call their bluff right now. Either they want the low ball offer or they're willing to come up to our terms. So if we're rejecting something, understand that's final. That's it. There is no going back. You can't revive it. It's dead on the table. So if your party wants to reject it, they need to understand those consequences. They're killing that offer. The other option then is to counter it. No with a but. I'm good with all the terms, but this, and this. Those roles reverse. The offeror becomes the offeree. And there's no end to how many times we can counter. We keep countering until we have acceptance or rejection from the last offeree. There's no magic number. We can go back and forth till the end of time, or until we get acceptance or rejection. Comments on that? Questions?
And this may be too far down the line, but
This sounds good.
well, it may be. What ties back, because you can be okay. I can be a seller's agent, and you have some sellers that feel their house is like, hey, I want to sell it at this particular price. I'm not going to budge. But at what point in the game, or at what point when you realize that, hey, this house is not selling? I mean, we've gotten a lot of offers. It fell through. This house has been on the market for 6 months. We haven't changed the listing price. At what point do you have that conversation with your seller about the listing price and the possibility of maybe reducing it?
I would say the first conversation in Kay, I love how our society changes words around and makes things sound better than what they are. We used to call it a price drop, but here lately I'm seeing it called a price improvement. All right, whatever. So, we're putting lipstick on a pig, right? Okay. So with a price improvement, to your point, we're in the listing if we're not getting showings, or if we are getting showings, but all the feedback is telling us that it's overpriced, then we need to listen to the buyer's feedback. I'm sorry, because the buyers are going to tell us what they think about the property. And if we want to know why it's not selling, listen to your feedback. But what if you can't get any showings? What if nobody's scheduling? So the price tends to be a good place to start. We're going to pull a fresh CMA. So our seller can see what the market looks like today, not when I listed it, but what the market looks like today. If your seller's not willing to come off the price, then you need to consider this when we're at the end of our agency agreement. We don't have to extend it. So if we're not selling it, the seller's not willing to budge, we're not getting anywhere, you don't have to extend that agency agreement. But what I do need us to understand is when we're in the agency agreement, it's old car all the way. So if you're working with unrealistic sellers that want a higher price, this may be something you need to decide before you enter into the listing agreement with them. Does that make sense? If you think they're being unreasonable and you know in your heart of hearts that you can't sell their home for this, then you need to consider that before you enter into the agency agreement. Because y'all, once you're in, and it's old car all the way. So, Kay, after 6 months, our agency agreement's running out. The sellers say, we really want to renew with you. They're like, yeah, but you're not working with me. So I think you would be best to work with an agent that, that you can, we don't have to renew, but we do all them old car when we're in. So setting down with the sellers before we sign the listing agreement, talking about that listing price, showing those CMAs, that's making sure that we all, and maybe your seller is unrealistic. So we say, all right, tell you what, we'll do it your way for 2 weeks. And after 2 weeks, if I don't have interest, then we're going to do a price improvement down to this. And I can put that in the listing agreement. I can throw that verbiage in there. So if we feel that they're going to be tough, but they're stuck on this price, then we have other ways that we can try to, sometimes they need to see for themselves. Sometimes they need to see for themselves. And with that being said, I don't want sellers to get a bad rap. A lot of people accuse sellers, they want more for their home. Y'all, value's in the eye of the beholder. And to the seller, this is their home. Blood, sweat, and tears went into this building. To everybody else in the world, it's just a house. So allowing the sellers to see the market analysis, allowing the sellers to see what's going on, pictures from comps, things like that. It kind of brings them more down. It gets their head out of the clouds a little bit, but we got to disassociate them from their home. I mean, I get it. I get it. You just have more value in it because it's yours. So yeah, let's see, we kind of mentioned this. Buyer makes an offer for 150. The house is listed at 200. And of course, the seller's just offended. Well, maybe we let the seller simmer down a little bit. Okay, here's the offer. Remember, I always have a duty to present offers, all offers. So maybe we let the seller simmer down just a little bit. I'll talk to you later today or first thing in the morning kind of thing. Bottom line though, the seller's response, they have 3 choices. They can accept it, they can reject it, or they can counter it. So if they're just that offended, if they can't get over it, then they may have to reject it. But like I said, I always encourage a counter offer for my sellers, always, even those low ball offers. You and I, and this is tough, you and I can't have emotion in this transaction. Buyers and sellers have enough emotion for all of us. So you and I have got to keep the emotion out of it because I'm not the one selling this house. I'm not the one buying this house. So let's be the voice of reason. Let's explain to them their options, tell them what their choices are, and help guide them towards their decision. I had sellers come in once. I don't know, the offer wasn't awful. I called it the jumping off point of negotiations. It wasn't awful. And then I called the sellers and presented the offer to him. Y'all know what he said? He said, they can kiss my butt, but he didn't say butt. And I thought, really? Really? What would you do with a lowball offer? You know what I'm saying? And I said, you don't want to count? He's like, no, I don't want to counter this. And I'm like, it's not. What do you want? You know, and what that did, because he did reject it. I couldn't talk it out of it, which is fine. That's his choice. But what it did is it allowed me to have the conversation with him about what it was he really wanted. I thought we were on the same page until that not awful offer came in, but he wasn't even willing to tolerate it, you know? So it made me think that he and I may not be on. It allowed me to have the conversation so we can move forward. I did get him under contract. I did get him closed. I'm not going to say the second offer was much better than the first, but it worked out. And maybe he just needed to get through that first one to reject that first one and get the second offer to see just kind of how similar it was. You know what I'm saying? The buyers were speaking to him. He just wasn't really ready to listen yet until he was. And then we got it taken care of. So we're going to end it here today. Hang on. I got like 2 more things to say, so don't go anywhere just yet. First thing I want to do, you guys should be looking at each other again. Is that right? Zoom's updated since the last time I've been on. So, and Zoom doesn't call me and tell me that they're going to do updates. So I'm trying to figure things out over here as I go. So hopefully everything went smooth today with Zoom. So tomorrow, very, very, very important. We set our clocks back tonight. Don't forget, it's daylight savings. So we fall back an hour. So tomorrow when we meet at 9, it'll actually be, I don't know, I can't do that math, but you know, we fall back. Don't worry about what time it would be. Just make sure you allow your clock to fall back 2 o'clock in the morning or whenever you wake up. Also tomorrow, we're going to start with our closing disclosure. So again, if you guys can print tonight, you have that email. If you can have it in front of you tomorrow, I think that would be helpful. If not, I mean, unfortunately, there's nothing I can do about that at this late game. But what I do want to make sure is you guys have that for your exams next weekend, your exam next weekend. But we're going to start with that tomorrow. And then when we're done with that, we're going to come back and pick up right here with the contract. And then we'll be on track the rest of the class. So that's where I am. That's what my agenda is tomorrow. What questions do I have? Comments, concerns, last minute thoughts? It's getting close to dinner time, isn't it? Or evening time, I should say. I'm going to send you guys an email this evening with a Google Drive link and a YouTube channel link. So be on the lookout for that. And in the meantime, if you guys have any questions, anything that comes up, never hesitate to reach out to me. It's painful for me to hear you guys say, I hate to bother you, but because you're not bothering me. This is what I want you guys to do. Fair enough?
Mm-hmm.
Fair
Yes.
enough. Y'all have a good evening. Don't do anything crazy tonight. I know it's Saturday night, but you got class first thing in the morning. So behave tonight. And I'll see you guys in the morning.
Okay,
Thank you. Have a great day.
Good night. Thank you.